Trading. I'm Danny Berger in London, and here are your top stories. Reversing course, Janet Yellen backtracks in 24 hours, saying the U.S. would be prepared to take more steps to protect depositors if needed. Europe is set to open in the red. DOJ scrutiny, Credit Suisse and UBS are said to be among lenders facing a probe into whether employees helped Russian oligarchs evade sanctions. We'll have their opening share price in just a moment. Plus, shares of Block tumble after Hindenburg Research says the payments company alleging it facilitated fraud, putting a short on the company. Block calls a report inaccurate, saying it will explore legal action. Well, that lift we're seeing to American equity, not really seeing the same when it comes to Europe. You are looking at European futures just seconds until this market opens, are overall down as much as 0.5% for the Euro Stoxx 50 future index, and markets are starting to open now. We do have some individual things that might be moving. For example, it's been a really bad week for the miners, so UK FTSE 100 opening down in that context isn't necessarily surprising, but it's the overall context of there being more nerves. Europe, at the end of the day, is a higher beta play, so if you're concerned about this market, perhaps that falls more. France and Spain both down by at least 0.4%. We're seeing more analysts cut their ratings, cutting their year-end guidance for Europe. Both Bank of America and Citi are cautious on these indices, saying that it is a volatile market, and there are still downside risks, and there's still an earnings contraction. So there you go. So far, you got UK, Spain, and France all open to the downside. But to contrast this, looking at what's happening across asset classes, U.S. futures are still higher. They're higher by 0.3%, maybe piggybacking off the story that there will be rate cuts in the U.S., even though that's not what the Fed says, that's what markets are pricing. Meanwhile, the global bond market rally continues in continental Europe. UK bond markets just opening now. Two-year yields are down by 4 basis points, and Germany down by 8 basis points. This has been the story of this week, the front-end rally. Meanwhile, the yen getting a bid this morning. We had inflation coming into Japan. Yes, the headline number, not necessarily bad, but really the drivers behind inflation are still sticky. Well, that means sooner normalization for the BOJ. So one of the top stories, one of the reasons, as well as the Fed cutting, says the market, that U.S. futures are able to rally is what Treasury Secretary Janet Yellen said yesterday. She's changed her tone on protecting U.S. bank depositors, telling Congress regulators are ready to take further steps if needed. Joining us now is Bloomberg Markets reporter Valerie Teitel. Valerie, is this Yellen bowing to pressure from the Fed?
Look, it was perhaps the fact she didn't like the market reaction to her comment 2 days ago that did steal a bit of the attention away from Powell's press conference. She had a direct edit to the opening statement, which really is just drawing more and more attention to the fact that regional banks are going to get different treatment versus the systemic too big to fail banks. This is the quote on the screen here that she added into that opening statement, saying they're prepared to take additional actions on deposit protection if warranted. But the big question is, Danny, what warrants it? Is it a regional bank that warrants it, or is it only those two big to fail systemic banks that warrant a special protection? You know, banking stocks really tumbled after that comment yesterday, but notably, regional banks tumbled the most. The more and more she draws attention to this bifurcated banking system, the more and more regional banks are going to suffer, and worries about deposit flight are going to continue.
Right, this is not necessarily the answer that the market wants to hear. This is not the certainty they've been looking for. Probably not helping that is the data we got overnight too, that banks are still withdrawing cash from the Fed's facility.
This is the second week in a row now that banks are drawing on the Fed for emergency lending. If you look at the numbers holistically, it does beat the numbers from last week. A whole $354 billion were taken from the Fed in emergency lending. You compare that to last week's 318. The discount window, their new emergency lending facility they announced 2 Sundays ago, were leaned on heavily. Also, loans to the FDIC. That's the bridge loans that the FDIC is using to resolve the Silicon Valley Bank and the Signature Bank depositors. Those also rose. But the notable thing about this release, Danny, was in this repo facility, which I want to talk about, is the FINMA repo facility. Someone used this facility to borrow $60 billion. Now, this repo facility was created back during COVID in a way to allow central banks who need some emergency dollar liquidity but don't have direct access to the dollar swap lines that the Fed has reopened. So this suggests there is a central bank out there in need of dollar liquidity, but the worrying thing out there is the max amount one counterparty can take is $60 billion, and that number showed up as $60 billion yesterday. So perhaps there is one central bank out there in need of dollar liquidity. That is a worrying sign.
Oh yeah, and just maxing it out at that. Valerie, thank you so much. Really interesting. Valerie Teitel there. Turning to the wider banking story, Stan Chart CEO Bill Winters spoke exclusively to Bloomberg in Hong Kong earlier today on the recent banking turmoil.
I hope we're through the worst. I think there's still some questions around business models around the world. Have there been weaknesses that have been exposed in the business models of any of the companies that have had trouble that need to be addressed at this point? But it certainly seems that the acute phase of the crisis is done.
At the same time, Bloomberg has learned that the U.S. is investigating banks, including Credit Suisse and UBS, over whether they helped Russian oligarchs dodge sanctions. For more, let's get to Bloomberg's Tom Metcalf. Tom, just when you think the bad news might be over, that there might not be anything left to hear, we get this news that there's potential investigation into Credit Suisse and UBS.
Yeah, exactly. And I think it's probably more wide-ranging than just those two banks. But it just goes to, sort of a great reminder just how risky banks can be. And here, one of the big sort of outlier risks when you come to the Russian situation, like, are you making sure everyone you're dealing with is not kind of impacted by sanctions, directly, but also perhaps indirectly. So, in terms of what this could mean, it's, these investigations are never good, and you'd expect, there to be some pretty severe implications if they're found to be in the wrong.
Yeah, and at the same time, of course, as this is all going on, you have UBS's con in Asia trying to retain some of the Credit Suisse top brass, which, of course, there's this irony to the fact that it is Iqbal Khan doing this. Where do we stand right now in terms of UBS absorbing Credit Suisse and any actions they're expected to take?
Yeah, some really interesting details from this town hall in Asia where, as you say, the wealth head Iqbal Khan basically going around and saying, look, we will have retention packages, and we understand that could be as soon as next week, basically to try and stem any kind of exodus of, the real top talent in Credit Suisse's wealth section. Those kind of bankers who might walk out the door with, hundreds of millions of dollars of client assets, with them. So it just goes to show it's a real situation UBS are in. They're trying to close this deal quickly, and part of that is because they just want to sort of set out their stall and make sure that the people they want to keep, the business they want to keep, is kind of in the same state as when it was bought.
Okay, Tom, thank you very much. Bloomberg's Tom Metcalf there. Now that UBS shares are open, a big tumble this morning, down some 6%. There's the concern that Tom was just talking about over potential Russian facilitation. But the other news coming out of this is that Jefferies has cut UBS, saying that the acquisition of Credit Suisse, their story of taking a U-turn, all of that means that it is high risk. They've put the price target now to 20 Swiss franc. That implies, for Julius Baer, I should say, they are putting a upgrade to BNP Paribas. So it is a story of different banks, but that's not helping BNP Paribas. Basically, all the banks are down this morning, so it's not necessarily just a Credit Suisse story. That concern, it is still very clear. Deutsche Bank has some individual news as well. It actually has to do with Madoff, believe it or not. We're going to get to some more of that later in the program. But yes, all the banking sector down this morning after we saw a turbulent session in the U.S. yesterday. Turbulence, that is the name of the game. There's no one else we'd rather navigate it with than BlackRock senior macro strategist Laura Cooper, who joins us now. Laura, okay, let's put aside the banking stocks for just one moment, because the big trade in the U.S. has been one of not believing the Fed, expecting that they will cut, pricing in more rate cuts. Again, besides the banking stocks, that's helped stocks in general, helped risk assets. Would you want to buy into that trade too?
Well, I think at this point, no, but it's really what struck me is just this decoupling that we're seeing across a number of factors in this market. So you alluded to the fact that markets are really pricing for the economic shock when we look at rates and the degree of pricing coming in there. But meanwhile, equities are still fairly resilient. We've actually seen, the NASDAQ, for example, continue to be quite positive gains year to date. And I think the key question is who is right in that scenario? Ultimately, our view is that we are going to see a Fed that is going to have to keep rates quite restrictive for some time because, yes, there are these banking fragilities potentially in the system, but at the same time, we are still seeing core inflation running at that 6% annualized rate. There is this risk that we could see another upside payrolls report. So against this backdrop, I think there's too many risks out there that the Fed will actually have to keep policy rates quite restrictive through the end of the year.
To that point of needing to keep things restrictive, General Mills, the consumer brand, had earnings yesterday, and one thing really stood out to me. They were talking about their cost input inflation, and they said that for the fiscal year 2023, they're expecting somewhere around 15% cost input inflation. Of course, that doesn't necessarily mean they're passing all of that on to consumers, but that still is a really stark number. Is there a risk that the Fed, even if they just slow down a little bit, even if they don't cut, but they just kind of keep things as is, that we could still have runaway inflation? And here's the words from their earnings exactly. And so are you afraid then that 14 to 15% that we could have runaway inflation?
I mean, I don't think runaway inflation is a risk at this point because I think, if anything, the tightening in credit conditions that we expect to further exacerbate over the coming quarters as a result of the fragilities that we are seeing is likely to further weigh on consumer confidence. And in turn, that does underpin our expectation that we are still going to have a U.S. recession later this year. So yes, inflationary pressures are likely to persist, but ultimately we do think there is going to be a degree of demand destruction that will start to cool those price pressures, albeit still remaining elevated before we expect the Fed to pause. Potentially May is when we're expecting them to reach that terminal rate of 5.25%. But again, a lot of uncertainty is still around that.
With that uncertainty, and you've even pointed this out in your research, the Fed is uncertain too, right? When in their meeting, their opening statement, when they were talking about the credit conditions tightening, they said the extent of these effects are uncertain. How much conviction can you have in the market right now?
Well, I think there's not a lot of conviction. Certainly, we've seen most central banks, from the ECB, the Bank of England yesterday, really just take this data-dependent approach, eliminating that forward guidance, which is probably prudent in this environment where inflation remains uncertain. Certainly, we have yet to see that deceleration come through that policymakers would want. And again, it's around the economic outlook. Just the fact that equities are pricing in something fairly upbeat, rates markets are pricing something different. If we look at rates volatility, it remains exceptionally elevated, but yet credit spreads, yes, they've widened earlier this month, but not to the extent that you would expect in this rates volatility environment. So in that backdrop, I think it's quite prudent to be cautious in deploying risk, especially when we look at where risk-free rates are, short-term government paper. We are seeing investors really hide out in that income-seeking type of exposures rather than deploying risk until we get clarity, notably on the policy and inflation fronts.
Yeah, if cash-like instruments are going to pay you that much yield, why take the risk anywhere else? Laura, stay with us. We have so much more to cover. That's Laura Cooper, BlackRock senior macro strategist. Coming up, French PMIs are due across your terminal any moment now. We're going to have the data and analysis for you next. This This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open. 15 minutes into your European trading day. A tough environment for trading isn't getting any easier. We're also now just getting French PMIs crossing the wire. Manufacturing PMIs coming in weaker than expected, 47.7. The forecast was for 48. March services, though, those are stronger, 55.5. The forecast was 52.5. The hope was to see, or maybe concern, depending on how you look at it, is continued economic gains. We know that the economy in Europe had been strong to start the year. You're looking, though, at the euro versus the dollar. Right when the European markets opened, when stocks started trading, we saw the gains in the euro completely wiped out, down by 0.4%. BlackRock senior macro strategist Laura Cooper is still with us. Always a straight line down makes for a jarring chart. What do you make of that? The fact that the euro, which has been seeing strength, all of a sudden is giving that up today?
Well, I think it probably captures the degree of uncertainty that markets are facing as they try to digest the potential ramifications of broader stress that we are seeing in financial markets. And potentially the weakness on the euro is a little bit of a knee-jerk move as markets potentially recalibrate to what the ECB could potentially do. Last week, the ECB was quite hawkish, signaling that they are going to continue to raise rates given this elevated inflation environment. And that still remains our view as well, albeit probably a slightly lower terminal rate, but largely this reflects this separation principle. The fact that central banks are going to continue to focusing on that data dependency, given the inflationary backdrop, while at the same time using other tools like balance sheet management in order to try to curtail some of the financial system stresses that could come through more meaningfully later this year.
So sterling is down too. Again, this might be also a factor of just some dollar strength. We were just talking in the break how Andrew Bailey of the BOE is speaking on Radio 4 at the moment. What do you make of this? Bailey has asked price setters to see inflation likely to fall, also adding, we think inflation will fall quite sharply. So asking the market here to price that in. What do you make of that?
Well, for anybody that was in front of their Bloomberg terminals on Wednesday morning at 7 a.m., we were quite surprised by the upside surprise that we saw in headline inflation in the UK, coming in at 10.4%. But what was even more surprising was the breadth of that inflation, and in particular pockets where you would expect demand to be curtailed the most, for example, like clothing, because that suggests that because prices are going up there, retailers are able to pass on those prices, which remains a key risk really to this broader outlook, in the sense that the Bank of England largely expects inflation, in the comments you just mentioned, to fall quite sharply by the end of the year, really underpinning the potential that yesterday was the pause in their hiking cycle. If we don't see that come through on the data, it does mean we have to have further hikes from the BOE. That's not our base case, but I think there's a lot of uncertainty just around the inflation dynamics, given that central bankers are really trying to grapple with this as well, just as market participants.
Yeah, and Bailey, I mean, also mentioning, to be fair, saying that rates will have to rise if inflation persists. Maybe that's kind of a no-duh statement, but to some degree, can the BOE really keep going? It's clear that there's fragility in the system, and given the mortgage environment, given the sensitivity to rates, does Bailey not have a lower ceiling than most central banks?
And that is actually aligned with our base case, in the sense that we do think the Bank of England is likely going to be the first to cut their policy rates among G10 central banks later this year. So in contrast to the Fed and the ECB, where we do expect rates to remain quite restrictive, we are anticipating potentially a Q4 easing to come through in the BOE, which is quite a different kind of narrative. But I think at this point, it's all about how to position portfolios in that type of environment. So it's probably the one region where we're getting a little bit more comfortable in taking duration exposure, potentially seeing that 10-year gilt yield go back to those 3% levels, so long as we start to see those inflationary pressures ease month on month. And then as well, looking at that short-term credit exposure in the UK for GBP-based investors, we think about you can get quite an attractive income at a fraction of the duration risk than full duration. So there are ways to position portfolios despite this kind of this fog of uncertainty that's really kind of facing markets right now.
Don't need to ignore UK markets. Laura, thank you so much. Really great to catch up with you today. Enjoy the rest of your Friday and your weekend. Laura Cooper, BlackRock Senior Macro Strategist. Coming up, Dorsey's fortune on the block. Co-founder Jack Dorsey sees $500 million wiped off his wealth. The short seller Hindenburg criticizes block payment firm. The firm fights back. We're going to bring you that story next. This is Bloomberg.
Out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah.
So what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
Hi, I'm Francine Lacroix. Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet, with guests like U.S. Special Presidential Envoy for Climate Change, John Kerry.
Climate has no affiliation with any party or ideology. Listen to the scientists. This is not a matter of ideology. It's not a matter of politics. That's the challenge.
Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
Welcome back to the Open. We are 23 minutes into your European trading day. An ugly day, especially in the banking sector. Euro stocks 50 banks down by more than 2.5%. Perhaps that market open has also prompted this stark fall we've seen in the euro. The euro was stronger versus the dollar to start the day. It has dropped off steeply, as has the pound. Andrew Bailey also speaking on radio right now, asking markets really to price a lower path of inflation. So maybe this is not just that, but it's also, as Laura Cooper from BlackRock was telling us, the market acknowledging that maybe the ECB can't be as hawkish as it wants to be. So those currencies falling versus the dollar. Now, in other news, Jack Dorsey's Block says it will explore legal action against Hindenburg Research. The short seller issued a report alleging the payments company facilitated fraudsters. Joining us on this is Bloomberg's Simone Foxman. Simone, what are the allegations here? What is Block saying?
Well, they chiefly have to do with Cash App, which allows people to instantly send money, stock, Bitcoin. And it's a wide-ranging report, but the basic theme is Block knows that there are a lot of fraudulent users, and some of these fraudulent users use the app to do bad stuff. So, for example, citing a former employee who said that there were 40 to 75% of the accounts on the platform are actually fake or fraudulent. Also accusing in this report that once the company finds a fake user, it doesn't necessarily go and root out all the other accounts associated with that user and delete them. And finally, I love this, pointing to rap songs that talk about Cash App and using it specifically to buy drugs, to murder people in one case. And then, of course, COVID-19, Hindenburg alleging that scammers use the app to get fake payments for COVID-19 relief, and the states are coming after them. So, of course, Block refuting all of this, calling it inaccurate and misleading, but those at least are the allegations at hand.
Well, considering what Hindenburg, the power they've had in terms of the market reaction with Adani, for example, how has the market reacted to these new allegations?
Yeah, don't forget Nikola as well. 15% decline in shares of Block yesterday. Now, Hindenburg says they see a decline of 65 to 75%. So we're only part of the way there. And you mentioned Hindenburg's track record. It's actually pretty good. When you look at the 30 companies that it has announced short positions against since 2020, after 6 months, all these shares were down about an average of 26%. Now, that said, there are supporters of Block here. Kathy Wood, ARK Investment Management, for one, seen to have purchased some $21 million worth of shares in the wake of this report.
Okay, Simone, thank you very much. Simone Foxman from Doha. I want to quickly bring you some stocks on the move. TUI planning a new share sale, 1.8 billion euros. They're going to repay some of their debt, so more dilution, shares down. JD Weatherspoons, their first half 2023 top and bottom line beat. That's a gain, and banking shares under pressure. Jefferies has cut UBS, those shares down 5.2%. as the entirety of the European banking sector falls this morning. Jeffrey says the risks, they're too high, and so is the uncertainty. This is Bloomberg.
is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40 year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to the Open. 30 minutes into European trading day. Here are the top stories. Reversing course, Janet Yellen backtracks in 24 hours, saying the U.S. would be prepared to take more steps to protect depositors if needed. Europe opens in the red. DOJ scrutiny, Credit Suisse and UBS are said to be among lenders facing a probe into whether employees helped Russian oligarchs evade sanctions. Plus, shares of Block tumble after Hindenburg Research shorts the payments company, alleging it facilitated fraud. Block calls the report inaccurate, saying it will explore legal action. European stocks slumping this morning. It's being led by banking shares. UBS getting a downgrade from Jefferies amid all the turmoil. Jefferies saying things are just still too uncertain at this point. So those shares down at 1 point, some 6%. It is clear everybody is going into cash. Bank of America just putting out their flow survey, their flow show from EPFR data, saying that investors put over $300 billion into cash in the past 4 weeks. That is the most since March 2020. At the moment, we're also getting some breaking news on Germany PMIs. It is a miss for manufacturing, 44.4. Forecast was 47. Services PMI, that came to 53.9. The forecast was for 51, so that is a beat. We also had French figures earlier. Same story, services that beat, manufacturing that missed. Let's take a look now at some of the sectors on the move. As I mentioned, it is banking that is having a tough go of it, this story. That also is translating, I should say, into a weaker euro too. So banking, that is down, energy, that is down, travel and leisure, auto. It really is these higher beta type indices that seem to be suffering this morning. The energy complex is down. Is oil down? Only slightly, 0.6%. The things that are gaining, it is some of those havens: healthcare, consumer goods, food, beverage, and tobacco. Just apparently I'm trying to combine them all into one word. Those are the sectors that are on the move higher this morning. So risk aversion is clear. And all at the same time, we have ECB officials. They're hawkish and they're getting bolder about the need for more tightening. With last week's half-point hike landing without incidents, a quarter-point Fed increase, some policymakers are again making the case for higher borrowing costs to tame inflation. For more, let's get to Bloomberg Economics' Jamie Rush. Jamie, before we get to the ECB story, do these PMI numbers strike you as surprising at all? We had France come in, services a little bit stronger, manufacturing not as much, pretty much the same for Germany too?
Yeah, I mean, I think that the picture here is one, generally speaking, of resilience, particularly in the services sector, which has done a lot better than people were expecting. And that's something that the ECB is going to be focused on. It's services that does the majority of the employment in the Eurozone. If that's looking strong, employment's going to be stronger, wages will be stronger, inflation will be stronger. So they'll be focused on that, and that'll just bolster the hawkish remarks we've heard recently.
So, I mean, this in part answers it, but what is the ECB using to back its argument to recalibrate its policy?
So Lagarde has been pretty clear that they're focusing on a few different things. One is really just still the same, which is underlying inflation, core inflation. The other is financial stability, and the other is inflation forecasts. But I think that for the near-term path, what matters most is core inflation. We're expecting it to stay very elevated all the way through the summer, which means the hawks are going to have plenty of room to push their agenda of higher interest rates.
Is Lagarde right to insist that there's no trade-off between price stability and financial stability?
Well, we've heard her say it quite a few times now, and I think she's right up to a point, right? So I think when we're talking about liquidity problems in the banking sector, the ECB is able to deal with those quite well. What it's not able to deal with is solvency problems. So if rate hikes go so far that it tanks the economy and losses start to pile up, the ECB is not going to be able to do anything about that. So she's right, there's a separability there, but only up to a point.
Okay, Jamie, thank you very much. That's Jamie Rush from Bloomberg Economics. Now, today in this market, it did start with euro strength. It has turned to euro weakness as the market opens. Let's talk about it with Samuel Zeev, head of global FX strategy at JP Morgan Private Bank. Sam, great to speak with you this morning. Just want to get your thoughts on the price action this morning. It had been a story of dollar weakness, Fed stepping back over the turmoil, euro down 0.4% today. Is the dollar strength, euro, that difference, is that over now, that play?
Yeah, I mean, I think it's highly correlated with what we're seeing in European bank stocks and bank credit spreads this morning. Honestly, the things that I'm watching the most when it comes to FX, these markets, I didn't think I'd say it, but I'm watching regional bank stocks in the US and I'm watching European bank stocks here. Because really, when I think about what's happening, let's say, in the global economy from an FX perspective, it's where is there going to be a tightening of lending conditions more, in the US or in Europe? When I think about the root causes of what's happening in the global financial system, there does seem to be something happening specifically in the U.S. smaller regional bank system. And these banks have been super important to loan growth in the U.S. over the last 3 to 6 months. If you're a loan officer survey at one of these small banks compared to a month ago, I think you're going to be less likely to extend credit and less willing to do that. In Europe, the banking sector is much more concentrated. I know we're seeing some pressure this morning, but it is more concentrated. You don't have the same types of issues with deposit outflows from some of the smaller banks. And so I just don't see why there would be such a tightening of lending conditions in the Eurozone relative to the US. And so if you're going to have more of a negative growth impact in the US, given what's happening there, you're going to have easier monetary policy. The Fed sounds more cautious than the ECB does, lower interest rates in the US. It's not exactly, usually you think of banking sector stress, you think of dollar strength. This doesn't seem dollar supportive to me.
No, it certainly doesn't, especially when they're putting liquidity into the system.
Exactly.
That's preventing that mechanism from working.
Yeah, I mean, basically, the amount of borrowing that's been done from the Fed and liquidity that's gone in has unwound, call it 3-4 months worth of quantitative tightening, right? So again, it's not, when I think about the differences between Europe and the US, this is negative for the U.S. relative to the Eurozone for me. And so it's not dollar supportive. We still think the Euro has more upside, actually, relative to the U.S. On this.
How much upside would you say? We're just above 107 at the moment?
Yeah, our numbers for the end of the year have been more like 115. So there's a little ways to go there for sure. And it's not just the Euro, right? There's a Euro story here, but really we think the dollar should be giving back some of the gains that it made last year against these alternative reserve safe haven currencies. Euro is one of them, but also Japanese yen, we think, is a real beneficiary in this type of environment.
Yeah, well, we did get Japanese inflation figures that showed inflation, at least the underlying inflation, is a little bit more sticky. But isn't there some degree where global turmoil makes yield curve control ending pushed to the backseat, pushed down the road?
Yeah, I mean, Japanese yen or anything against the Japanese yen it's easy and hard in FX because at least there's only one thing we have to focus on, and it's interest rate differentials. So our view has been quite bullish on the Japanese yen because we knew that those interest rate differentials were going to narrow one way or the other. Either inflation and the global economy was going to stay hot and Bank of Japan would move away from yield curve control, and that would narrow the interest rate differential, or what we're getting now. The global economy is slowing. The U.S. is heading into recession, most likely. Interest rates globally will converge to those in Japan instead of those in Japan catching up to those in the rest of the world. that's still bullish for the Japanese yen in my book.
Well, one of the other big stories, at least it used to be the big story of the driver of the yen, was just yen is haven. That obviously didn't happen because it was the dollar is haven. If the U.S. is a concern, can that story come back?
It can, particularly because U.S. interest rates are coming from such high levels. They're going to be declining. And again, so I think the Japanese yen benefits here. I think the euro is honestly a beneficiary here. Even the Swiss franc is a beneficiary here. We're not really making a bullish call at the private bank where I sit on global growth over the next 12 months. And so when we think about where the dollar can sell off, we are concentrating mostly on these core reserve currencies rather than, let's say, high beta or emerging market currencies.
I want to ask you something that our reporter Valerie Teitel was talking about earlier, and it's this Fed foreign central bank facility. So central banks can tap this. The most they can tap is $60 billion, and $60 billion was tapped in 1 week. Of course, we don't know who is doing this, but what do you make of that?
Yeah, I'll say that there's a couple of us that were sending emails about this last night. We don't know who it is. I will point out that $60 billion, when converted into Swiss franc, is awfully close to the liquidity facility the Swiss National Bank has offered to its banking system, but we honestly don't know. I think what's really important about the repo facility, though, at the Fed, and I used to sit there, is it prevents the Treasury securities that are being posted at the facility from being sold in the open market. So one thing that I think is really important from this, because at the private bank, we've been quite constructive on duration and owning the long end of the curve. Just having this facility is exactly why this exists. So these central banks don't need to sell in the open market their Treasury securities, put upward pressure on interest rates. If anything, it helps insulate the financial system.
Okay, so that, and there's also just the dynamic of having these facilities in general, their existence helps things. One of the things that this market is craving for is more confidence when it comes to the uninsured deposit question. We even had Pascal Donahoe speaking just moments ago. He's in Brussels at the EU Leader Summit saying that Europe also needs to figure something out. How important is this question for American assets, for European assets? Does this need to get answered? Do policymakers need to have a stronger line or stronger policy?
It does seem like this could be an ongoing issue in the U.S., and so I wouldn't be surprised if we hear more from policymakers on that front. In Europe, but we have evidence that there are deposit outflows from smaller banks moving to other larger institutions in the U.S. and money market funds. We're not, at least in the data that we're looking at, we're not seeing that in Europe as of yet. I'm sure that having more blanket deposit insurance could be a good thing for confidence in banking sectors globally, but it doesn't seem like there's an acute issue with deposits in the Eurozone just yet.
Before I let you go, I do want to talk about EM. You briefly mentioned it. The one that caught my attention and most people's attention yesterday was the real. You have Brazil, their hawkish hold, really fighting against the political language coming out of Lula and others saying interest rates shouldn't be this high. Yet the real's gains haven't been sustained. We saw it fall versus the dollar yesterday. Why not? Why not continue to buy the real at this point?
Yeah, so again, when I think about emerging markets, we're not bullish on global growth, frankly, in the private bank, right? And so those are usually the currencies that are going to benefit in that type of environment. Now, you've seen a variety of emerging markets, particularly in LATAM, and the real is one of them, because their central banks were so aggressive in 2021 and 2022, they built up a nice interest rate buffer against the dollar, let's say. If I had to choose, I think, between LATAM currencies, I'd probably be sticking more with the Mexican peso than the Brazilian real. But we do see good reason that maybe the real doesn't see outright strength, but you can make positive total returns there, just given the amount of carry that it offers, particularly if global or developed market interest rates are going to be falling.
And so just 30 seconds here, but why the peso? Why is that the preferred currency?
It just seems to have a slightly better, it's a more resilient, hawkish central bank. It has a better fiscal and external balance, if you ask me. So the fundamentals just look a bit more supportive to me.
Okay, easy answer. Sam, thank you so much for joining. Really appreciate it.
Thank you.
Enjoy the rest of your weekend. That's Samuel Zeev, Head of Global FX Strategy at JP Morgan Private Bank. Coming up, we're going to talk tech. NVIDIA's CTO speaks to us about ChatGPT, chips, advances in AI. All of that up next for you. This is Bloomberg.
think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco. New hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg. Moment news breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of 3 very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
Welcome back to the Open. Just over 45 minutes into the European trading day, stocks continue to fall across Europe. We're at the lows of the morning, down more than 1% on all these regional benchmarks, about 1.4% for a lot of them. This is also following some bond buying, strong bond buying we're seeing on the front end for US, for Germany, for the UK, really everywhere as those bets stack up that the Fed will be cutting rates. We're also looking at a falling euro. Perhaps there's some concern with banking stocks selling off today that the ECB won't be able to hike as much as the hawks want to. That's at least what we're talking with Samuel Zeef about, who's, of course, over at JP Morgan Private Bank. So you're looking at the front end in Germany and the UK. They are at the lowest for the year. In the UK, those 2-year gilts at the lowest since November of last year. One sector that has been extremely resilient in the U.S., at least, has been tech. Shares in NVIDIA closed higher in the U.S. yesterday following the company's release of a new AI-focused chip and supercomputing services. Everyone's very hyped about AI right now. In an interview with Bloomberg, NVIDIA's chief technology officer said the company is doing more than ever to ensure new technologies are being used ethically.
Every new technology and every new revolutionary technology, it's opportunity for doing good things and for opportunity for doing bad things. And we definitely need to be aware of this and be ready to mitigate this. We at NVIDIA, work very closely with collaborating with the regulations. We are to extent that we can make sure that our technology and our products don't get to the bad hands. We can't trace it down all the way to the end user, but we make sure that people that we sell our things for, our technology for, and our products for, are not using them in the way that will damage the society.
Okay, so you're confident that in terms of the framework and the focus on ethics of AI, that NVIDIA is doing enough?
I think NVIDIA is doing more than enough. We are on the very extreme case side of this. We are definitely not doing anything in the gray area. It's very black and white. We are not getting to the gray area, and we're also developing the technologies that will enable to mitigate cyber attacks in the data center. Actually, now there is people even more dependent on the data center infrastructure, and we are building the technology that will enable the provisioning and mitigating the cyber attack within milliseconds or seconds versus few months that is what it takes today.
You have customers, NVIDIA has customers, of course, all over the world. You're a global company. Some of those customers include Chinese companies, Alibaba, Tencent, Baidu. How do you serve your Chinese clients and customers given the ban by the US on those high-end chips, the A100s, the H100s? How do you continue to serve those Chinese clients?
Okay, so first of all, if you look at the Chinese market, it's a big market, and they better have the computing accelerating technology, so they will use a reasonable amount of energy. There is a ban on the restrictions of sell some type of chips to China market, and we have chips that comply with the regulations. We're definitely not violating any regulations of the U.S. government. We have products that we can serve China market within restrictions and within the rules that are imposed by the U.S. government.
NVIDIA CTO Michael Kagan there speaking to Bloomberg's Tom McKenzie. Let's get to your Bloomberg First Word News now with Simone Foxman. Simone.
Thanks, Danny. Japan's inflation has slowed for the first time in more than a year as government energy subsidies masked a stronger underlying trend. Consumer prices, excluding fresh food, rose 3.1% in the year to February, dropping more than a percentage point from the previous month. However, a separate index that strips out volatile prices rose at its fastest pace in over 4 decades. U.S. prosecutors are to seek the extradition of Terraform Labs co-founder Do Kwon after charging him with fraud. The 31-year-old was arrested in Montenegro, where authorities say he was trying to fly to Dubai using falsified travel documents. Kwon helped create the Terra USD stablecoin that collapsed last May, triggering a $40 billion cryptocurrency implosion. Kwon's lawyer has previously said he'd seek to dismiss any U.S. lawsuit, and Kwon says he's not on the run. Accenture is joining the growing list of companies in the consulting sector that are laying off workers. The firm says it will cut 19,000 jobs over the next 18 months. That's about 2.5% of its workforce. Over half the job cuts will affect people in non-billable corporate functions. Global news, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Simone Foxman, and this is Bloomberg. Danny.
Simone, thank you very much. Coming up, the TikTok CEO testifies to Congress. Was it enough, though, to placate lawmakers seeking to ban the Chinese-owned app? We'll have that for you next on Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He caught himself self-made day trader. Yes. And so he's on the bus
after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year, and so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
About 55 minutes since the market opened, and it is getting uglier and uglier. Stocks down across the board in Europe, down more than 1%. Banking stocks deteriorating might be the reason, says JP Morgan, that we're looking at a euro falling this morning. You're seeing some dollar strength. That's also translating into a bad day for crude. That's at the top of the commodities column, down nearly 2%. Bonds are being bought everywhere, be it the UK, be it Germany. Both of those yields on the front end are at their lowest for this year. So the market environment deteriorating into the weekend. Why would you want to hold risk considering what happened last weekend? Let's talk tech, though, and TikTok CEO Shou Chew faced a bipartisan grilling on Capitol Hill yesterday. U.S. lawmakers are seeking to ban the Chinese-owned app as a security risk. Chew insists there's no evidence that China has access to user data. He also says security and privacy concerns are not just limited to TikTok.
The potential security, privacy, content manipulation concerns raised about TikTok are really not unique to us. The same issues apply to other companies. We believe what's needed are clear, transparent rules that apply broadly to all tech companies. Ownership is not at the core of addressing these concerns.
Let's get to Bloomberg's Alex Webb. Alex, did this help or hurt TikTok?
I think it's very hard to make the case that it helps them. It was also, the CEO wasn't exactly set up for success. He went into the room, almost all lawmakers seemed to have a very clear view on what they thought of TikTok, and it wasn't a positive one. It was very little that he could do to convince them otherwise, and he certainly didn't seem to do so.
What has been the Chinese government's response to this?
Well, we've had some reporting that the Biden administration has set a sort of ultimatum to ByteDance, the parent company, that they need to either exit the American market or sell TikTok. And China's come out pretty strongly and says we will not allow them to do, we will not allow a forced sale of TikTok. There are also plenty of questions like, how would that look? Is it a sale of TikTok in its entirety? Is it a sale of just the American arm? If it's a sale of TikTok's entirety, we're looking at several $100 billion of valuation. How could that even happen? There are lots and lots of questions before we would get to that point. So it's very much clear as mud.
Okay, Alex, thank you very much. We'll see if it gets any clearer in the days coming forward. Probably not. Alex Webb there covering the latest on TikTok. As we close out the hour, I just want to show you again the dramatic sell-off that's taking place in markets. Stocks are selling off, as is the euro, as is sterling. Dollar is getting a bid at this moment, something we haven't seen in this recent banking turmoil. Oil is lower off the back of this. Bonds being bid, front end of the curve dropping dramatically, the lowest of the year.
CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The strong actions we've taken ensure that Americans' deposits are safe. Certainly, we would be prepared to take additional actions if warranted.
They do not have the authority without congressional action to ensure the deposits in open banks.
I think what they did was broadly appropriate. There's a lot of uncertainty and a lot of cards are going to be turned over.
Next 1 or 2 weeks will be very crucial for the banking sector.
This is an important period. They've got to show that they can manage both this as well as a crisis in confidence.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. More fallout from the Swiss bank deal. UBS tries to prevent an exodus of Credit Suisse's top talent in Asia. Meanwhile, both lenders are said to be facing a probe into whether employees helped Russian oligarchs to evade sanctions. Janet Yellen tries to reassure markets. The Treasury Secretary says regulators are ready to take further steps to protect the banking system if needed. And EU leaders will renew their push for a banking union in the wake of the recent turmoil. They'll be joined in Brussels by the ECB President, Christine Lagarde. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Matt Miller is off today. And Kriti, it is very nice to be back with you today. Apparently, I missed something of a wild ride on markets. Whether that is over is a big question because European stocks selling off once again today.
Yeah, I have to say, missed a historic rate decision, Anna, but that's okay. I'm sure there will be plenty more to come, reflecting in some of the risk-off sentiment that you are seeing in the markets today. To your point, you see it in Europe, you see it here stateside as well. Take a look at what futures are doing right now. Simply this idea that they are down 0.2%. No major conviction, no major sell-off just yet, but certainly something that could be setting the tone for the rest of the day. Remember, it is going to be a weekend here, so there is going to be this natural sentiment, given the banking turmoil, that they're to pull out ahead of whatever news the weekend may bring. I also want to get to the bond market here, Anna. The historic rate decision that you missed put the markets into a tizzy. The 2-year yield, 371 is what we're looking at. A 12 basis point move lower already. A lot of that coming out from data that you are seeing over in Europe, actually having a read through into the U.S. market. But I think for me, what's so striking is that the 2-year yield is sustainably below 4%. And that just means that the market, at the end of the day, is pricing in rate cuts, even though the Federal Reserve has been very clear that they don't have rate cuts on their mind at all. And nevertheless, as you see yields drop, the dollar actually stronger. And once again, this coming from weakness in the euro, again, from that European data. So it feels like Europe really in the driver's seat today, Anna. The dollar higher by about 0.4%. NYMEX crude is going to continue to be a story as we inch closer and closer to potentially $100 a barrel, even though some of the Wall Street consensus is that it's not going to get there. 68 handle on NYMEX crude.
Let's have a look then at the European picture, Chrissy. And as you mentioned, we are seeing some weakness coming through here. So European stocks definitely on the back foot, down by more than 1% on the FTSE, on the CAC 40, and on the Xetra DAX. In focus, the banking sector. Let's roll on and show you where we are on the banking story, because the banking sector is the weak spot today for European markets. We're down by just over 3%. So if you thought this was over, we're now selling off again on European banks. Just to put that in context, back to where we started the year. So we've unwound once again all of the gains of 2023 in terms of that European banking sector. We'll see if we bounce again, which is what we did last time we were at this point a little bit earlier on in the month of March. Interesting to see the UBS group is down 5.2%. We've seen downgrades on the banking sector to Deutsche Bank. We've seen downgrades from some analysts around UBS group as well. So analysts having their say on what they see as the future shape of Credit Suisse and UBS together, what that does to their ability to make estimates there. Jeffrey's taking a downgrade to UBS. We've seen a downgrade, as I say, to Deutsche Bank. Are we through the acute phase of this storm? That's how we saw it described by some. Bill Winters over at Standard Chartered has used that phrasing as well. So that's certainly one of the big questions as we watch what's happening here. Away from the banking sector, JD Wetherspoons, if you need a drink, this is a pub chain, and this is maybe where many people's heads are as we head into Friday, a little bit early perhaps, but certainly getting towards the weekend. If people are looking for something a little bit different, then here is a hospitality business, I should say, and the stock is up by just over 7%. It seems some of the supply chain issues that have been bothering the business, not so much a focus. But back to the big picture, back to the macro. Here's the weakness in the euro that, Chrissy, you were referencing, and I'll pull together a few themes here. Is the weakness in the euro, is it just to do with flight to the dollar? We are seeing some dollar strength in amidst the turmoil in other markets today, so that's worth noting, and so that's weakening the euro, weakening the pound. Is it to do with weakness in the European banking sector? Is that what we're seeing expressed here on the macro front as well? Or is it to do with some of the data that we just had? We got euro area manufacturing PMI that came in at 47.1. That was below the forecast. So just as we saw from Germany and from France, there's weakness on the manufacturing side, below the forecast and in contraction territory. In contrast, the services side is well into expansion territory and above forecast. So a mixed picture really coming through on those PMIs then, Chrissy.
Yeah, is it what came first, the chicken or the egg? That seems to be the story in the currency and the bond markets. And I want to get to a Bloomberg exclusive. UBS wealth boss Iqbal Khan told Credit Suisse staff in Asia that retention packages could come as soon as next week. For more, we're joined by Bloomberg finance editor Tom Metcalf. Tom, why is UBS taking such drastic measures?
Yeah, really interesting insight into this town hall he was doing in Asia. And basically, you know, they're looking at these Credit Suisse wealth bankers. One of the main reasons UBS, you know, was sort of incentivized to buy Credit Suisse, and they're desperate for them not to walk out the door, you know, particularly the top talent here. So what they're really looking at kind of rewarding or sort of locking people in is those bankers who, if, say, they move to another rival, might take, you know, hundreds of millions of dollars worth of clients' assets with them. So, you know, clearly a move here, and it goes to show, I think, where UBS's priorities are. It's the wealth business, it's the asset management business, and that's where they will be, you know, seemingly happy to sort of pay up a bit just to make sure they get what they bought.
Okay, so they want to make sure they get what they bought, focus on those wealth clients. Really interesting to see Iqbal Khan playing that role there, given his role at both Credit Suisse and UBS, of course, previously at Credit Suisse. Now, Bloomberg has also learned that the US is investigating banks, including Credit Suisse and UBS, over whether they helped Russian oligarchs to dodge sanctions. How big a deal can this probe be? It isn't just these two banks, but clearly they stand out.
Yeah, look, sanctions probes are never good news, right? And you know, if you look in history, you know, some of these sanction probes are resulting in fines like, you know, in the billions of dollars. So, you know, this is UBS, Credit Suisse. We understand there's a few US banks involved as well. So no, it could well be pretty significant. And I do wonder whether those banking moves you were just outlining, you know, this downdraft in the market today is at least in part impacted by this news.
Bloomberg's Tom Metcalf, thank you as always for breaking down that story. The saga continues over in Switzerland. Stateside, the Treasury Secretary Janet Yellen says regulators are prepared to take more steps to protect the banking system, only if warranted. That comment to Congress came a day after her remarks on nationwide deposit insurance that rattled markets. Enda Curran, Bloomberg economic reporter, joins us now for more. Enda, it's interesting. We're talking about reinsuring deposits, but what's the thinking here on how that's going to get funded?
Well, I guess the first point was the Treasury Secretary was trying to calm markets and reassure investors, like you said, and roll back some of the confusion that came out of her earlier remarks to lawmakers during the week. She was essentially saying the Treasury is there, willing to take whatever steps are necessary to backstop depositors when it's merited. So she's trying to tread a fine line. She's obviously not wanting to suggest that they had the authority to give out these kind of blanket backstops to banks and depositors, but she also realizes, of course, it's a very fragile situation, very fragile sentiment towards U.S. regional banks in particular at the moment, and she's trying to make clear that regulators do have options that they could consider when and if it's needed. So, you know, it's a confidence play. It's a classic role of an economic official, trying to ensure confidence in the system, reassure investors they're willing and ready to take whatever steps are needed. But of course, she has to balance the the realpolitik of that situation as well, making sure Congress are inside, while also, of course, trying to tread the whole moral hazard debate.
Yeah, absolutely. I mean, Enda, there might seem to be a tension between the comments we heard from her one day versus another, the first day of testimony versus the second. But Dan Tarullo, formerly of the Fed, making the point to Bloomberg TV in the last 24 hours that there is a difficulty here because there are limits to what the Treasury can do, along with the FDIC, without the support of Congress. And that's what's being reflected in the two different testimonies that we got from Yellen here.
Yeah, no doubt about it. Politics is a big part of this. You know, essentially the Treasury would have to make sure they've got the political backing, the backing of Main Street to go out and say, backstop the banking system in one shape or another. That's not always popular. You know, banking depositors is one thing, but backstopping other parts of a bank doesn't necessarily always go down well with the public and making sure that the taxpayer isn't on the hook. So there's lots for the Fed and the Treasury to navigate in this. It's the same story for regulators all around the world when it comes to dealing with the banking issue. But I think right here, right now, the biggest focus for Ms. Yellen and others is trying to drum up confidence, talk up confidence that the regional banking story in the US is under control, that there isn't a systemic threat to the broader banking system and certainly not the bigger banks. And that's obviously the core message that the authorities are trying to get out there at the moment.
Yeah, Enda, thank you very much. Bloomberg's Enda Curran joining us with the latest on what we heard from Janet Yellen and indeed the broader banking story. Now, banks in focus for European leaders as they gather. They'll continue a high-level meeting today, a second day of those meetings taking place in Brussels. Yesterday, the key focus was on Ukraine. Today, it's all about the economy after a week of turmoil. ECB President Christine Lagarde will join leaders to brief them on the economic and financial situation in Europe. Let's bring in Bloomberg's Maria Tadeo, who's in Brussels. Good morning, Maria. What can we expect then from President Lagarde?
Yes, good morning, Anna. And this is a meeting that I believe should have started, but has actually not, because I can still see motorcades coming in from European leaders gathered here. And of course, the big star of the morning is going to be the head of the European Central Bank, Christine Lagarde. There's a lot of appetite here, and you can really see it from the political side of things, to really hear from the central bank the assessment of what happened on a very turbulent week for banks. And again, once again, and you alluded to this at the start of the show, we have seen a frenzy of communications from the head of the European Central Bank. This is the fourth time she speaks in a week, but sentiment keeps flipping. We've seen that European banks are now down this morning. So again, she's going to have to go back to this message of instilling confidence in this market. And I suppose and presume, once again, hammering down this message that they can handle both price stability and financial stability. And that means bringing inflation back to 2% target. But it is obviously a tough environment for the head of the European Central Bank because the sentiment just continues to flip over and over. The question is now what kind of remarks she'll tell European leaders. This will be behind closed doors, but obviously we'll try to bring you anything that we can hear. We'll be on the case to chase anything for you.
Meanwhile, Maria, the war in Ukraine rages on. President Zelensky spoke to leaders yesterday via video conference. Walk us through what he said.
Look, President Zelensky did participate in this meeting. Now, he's done it now pretty much essentially for every European summit since the war started. And a source told me that essentially it came down to two messages. One is that he concedes essentially that he cannot put a date to the end of the war, but he is convinced that this joint effort, the stamina from the West to defeat Russia cannot recede. Those were his words. Then secondly, again, repeating this idea of we need the ammunition, no more delays. And also he questioned the rationale as to why Ukraine cannot get access to modern fighter jets. So a lot of the same narrative we heard in a week, which, by the way, was politically, geopolitically very important. You had the leader of China, Xi Jinping, going to Moscow. A lot of this overshadowed by the vibrations of the market. But nonetheless, the war is still going. And that was a message from Zelensky yesterday. This is still fighting, and just the pace of fighting has intensified to the extent that Europeans have now promised that they will deliver 1 million artillery shells in 12 months. That just gives you an idea of just how intense this is.
A crucial and frankly heartbreaking conversation. Maria Tadeo in Brussels covering every angle of it. We thank you as always. I want to bring the story back to the States here and into the markets. The payments company Block exploring legal action against Hindenburg Research after the short seller claimed that it facilitated fraudsters. Block called Hindenburg's report factually inaccurate and misleading. The stock is down in pre-market to the tune of about 4.2% after suffering its biggest intraday decline in 3 years just yesterday. I want to get to some of the other stocks we're watching as well, because Square and Block, or Block formerly known as Square, is not the only one that's down. First Republic is as well, but take a look at the conviction here, Anna. It's only down 0.2%. These are not the 40, 50% swings in either direction that we are so used to over the past couple of weeks. So it really brings to the question of how much of the trade in some of these banks is actually based on fundamentals as opposed to other factors like technicals, for example, or simply vehicles of volatility. It gets a little nerdy, but stick with me. On the other end, you do have some major gainers. A defensive bid into the market. NVIDIA, for example, on track for a 10th straight day of gains. Again, lacking a little bit of conviction in the pre-market, but keep an eye on this name because it is higher by 0.2%. Every time we see some sort of defensive bid into the market, NVIDIA rallies even more, in addition to, of course, their investment in AI, which continues to be a theme in technology, Anna.
Coming up on the program, then we'll talk about the broader markets, the sell-off we're seeing into the weekend here in Europe. How much do we need to read into that? We'll talk to Henrietta Packmore, head of global fixed income at Allspring Global Investments. Is this to do with banking weakness? Is it to do with the way that central banks are tapping Fed facilities? We'll certainly get into that conversation. We'll also discuss TikTok's fight against US lawmakers. It was intense yesterday on Capitol Hill. Lindsay Gorman joins us, senior fellow for emerging technologies at the German Marshall Fund. Where does this leave TikTok? And can it survive as a platform in the United States? We'll get into that conversation shortly. This is Bloomberg.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. The moment news breaks, no one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of three very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
Well, Well, it's been a fascinating day, and I would say week, month in the markets. It kind of feels like we're going back to a little bit of habitual trading when it comes to how you actually play a market where you don't really know what the Federal Reserve is doing, you don't know how bad the banking crisis is, and you really don't know how effective the moves to kind of tamper down inflation are going to be, and of course the timeline on all that, plus the scary R word. When you have that kind of uncertainty, it only makes sense to buy those defensive stocks, and surprise, surprise, that is exactly what we are seeing. Take a look at this chart for our radio audience. Stick with me here. We are looking at the quarterly percentage change in the MSCI World Growth Index relative to the value index. So think about your names like your Apples, your Microsofts, anything that has that kind of a long-term value add. Those are the stocks that are outperforming. And might I add, outperforming by the most, going all the way back to 2000. It really speaks to the idea that you are seeing a defensive trade and potentially the start of another bull market rally, at least if you are defensively led in a defensively led index like the S&P 500. Joining us now for a little bit more context, Bloomberg cross-asset reporter Denitsa Sakova. Denitsa, what do you make of this tech rally? Is it just defensive, or do you think there might be something a little bit more sustainable to it?
Yeah, so what we've seen really is that crazy tech outperformance. Really, what we saw, value was doing very well for a long time, and now tech is back. Of course, a lot of this ties in with what we're seeing of market expectations of the Federal Reserve. We've seen the market has been quite positive. It's seeing peak rates in May. It's pricing in a lot of rate cuts going forwards, which, of course, a lot of people are saying won't happen. Even the Fed has been reluctant to say that, and he's said that there will be no rate cuts. So, of course, this big bet on tech is very reliant on what the Fed does next and what we're going to see from inflation print.
Yeah, absolutely. And with that focus on tech, the Nasdaq now nearly in bull market territory, isn't it, Denitsa? Let me take us broader, though, and think about the attitude to risk that we're seeing in markets here, because we're seeing something that our colleagues on the Markets Live blog say reminds them of 2008. Not necessarily the scale of any crisis, a lot of different views out there on where the banking sector goes from here. But the way that we're seeing markets position ahead of the weekend, we're certainly seeing a sell-off in risk assets ahead of the weekend here in Europe.
Yeah, I mean, it's been an interesting week. We saw the VIX spike initially, now the VIX is down. We saw bond volatility spike initially, now bond volatility is down. S&P has been up for 2 weeks, if today, obviously, the moves hold. So people would read that things have not been that negative, but we actually saw, in terms of global flows, we saw people selling equities at the fastest pace in 7 weeks. So there is some reduction of risk exposure. Of course, it's important to remember that investors overall went into this with slightly underweight equities, so there hasn't really been a huge move, but investors are definitely reducing risk. Another interesting thing we're seeing is investors are hedging volatility. We've seen a rise in investor buying VIX options and calls, but that's not for immediate future, but rather for the next couple of months. So there is definitely some anxiety that there may be a spike in volatility and more downturn from here.
Yeah, and weekends can be dangerous things, as we know. The UBS share price down by 5.2%, European banks down by 3.3%. Denitsa, thank you very much for the analysis. Denitsa Sakova joining us there on the markets. For more market analysis, check out MLIV Go, the function to use on your Bloomberg terminal. This is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Matt Miller is off today. Now, keeping up to date with news from around the world, here's the first word. U.S. prosecutors have charged Terraform Labs co-founder Do Kwon with orchestrating a massive cryptocurrency fraud. It's said to have wiped out at least $40 billion in market value. Kwon was already a fugitive from charges in his native South Korea and was arrested Thursday in Montenegro. Billionaire bond investor Jeffrey Gundlach is joining the Jerome Powell is wrong chorus. The chief investment officer of DoubleLine Capital sees the Federal Reserve cutting interest rates substantially soon. Markets are signaling the Fed is wrong when it talks about the prospect for further interest rate hikes. On Capitol Hill, the appearance of TikTok's CEO failed to placate lawmakers eager to ban the viral video sharing service. Shou Chew told a House committee that TikTok operates independently of its Chinese parent firm. But members of the panels clearly didn't buy his answers about whether China could access the data of the app's American users. Twitter will start removing so-called legacy verified marks from user accounts next week. The platform is working toward a model where only paid subscribers and members of approved organizations have that status. Twitter has made the blue verification mark a major feature of its Twitter Blue subscription offering. Owner Elon Musk had priced it at $8 a month, Anna. A lot going on in the social media space.
Absolutely. We'll talk more about TikTok and its fate later on in the program. Up next, though, we will get back to the markets conversation. Henrietta Packmore joins us, head of global fixed income at Allspring Global Investments. We've seen incredible volatility at the short end of the U.S. rates curve. That continues, really, with sizable moves. We're seeing the two-year yield come down another 13 basis points this morning, 3.69%. Where does she expect the Treasury story to head next? This is Bloomberg.
institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. More fallout from the Swiss bank deal. UBS tries to prevent an exodus of Credit Suisse's top talent in Asia. Meanwhile, both lenders are said to be facing a probe into whether employees helped Russian oligarchs to evade sanctions. Janet Yellen tries to reassure markets. The Treasury Secretary says regulators are ready to take further steps to protect the banking system if needed. And EU leaders will renew their push for a banking union in the wake of the recent turmoil. They'll be joined in Brussels by ECB President Christine Lagarde. I'm Anna Edwards in London with Chrissy Gupta in New York. Matt Miller is off today. And Chrissy, European equity markets selling off once again as a result of concerns around the banking sector, it would seem. They seem to persist into the weekend. And US futures look a little unsure of which direction to head in right now.
Yeah, a little lack of conviction, a little lack of momentum, but also completely natural on a Friday. And I think in the last couple of weeks, we've seen this hesitation to really kind of hop into the market on Fridays, specifically given the banking news. A lot of that happens when markets are closed. Remember, we are still waiting on news for things like acquisitions of First Republic stateside, the readout on the UBS Credit Suisse deal. A report just yesterday that deal might take place fully at the end of April in terms of the actual merger. So a lot to digest, a lot of which, again, happens over the weekends. To your point, Anna, though, futures down about 0.4% on this side of the Atlantic. The bond market is what catches my eye here. 2-year yield sustainably above 4% and with no signs of heading back to that key level. 369 on the front end of the curve, a 13 basis point move already baked into the markets. Now, some of this is going to be from the read-through of the European data, but some of this is also going to be this massive amount of rate cuts that the market is pricing in going into the back half of the year. That kind of essentially puts a lid on yields when it comes to the U.S. bond market. The dollar moving in the opposite direction, though stronger by 0.3%. I'm told a lot of that was happening when the European markets actually opened, so not necessarily data-driven there, but certainly a lot of fund flows moving in the FX space, stronger by 0.3%. NYMEX crude, though, Anna, trading at a 69 handle, something we have to watch when we talk about the inflation story. That's the macro picture. I want to get to the micro. Square is top of mind, or Block, I should say, now it's known. I have to get rid of that habit. It's kind of a tick for me. Block, formerly known as Square, Jack Dorsey's child, basically, down about 4% on the day. This comes after they vowed to fight back after Hindenburg Research had a report yesterday alleging lapses in the compliance process. So a lot there. Block has very openly said that, look, they're going to fight the potentially Hindenburg and SEC on any sort of those allegations because they just don't want the pain in their stock market. First Republic also top of mind, remaining volatile after a whipsaw from Yellen's comments yesterday. And remember, we are going into that weekend. How much of that news are we going to get? Those shares higher by about 0.2%. NVIDIA now pairing a lot of their earlier gains. Remember, they were on track for their 10th straight day of gains. Now it looks unlikely they're going to hit that 10th day. But nevertheless, Anna, that defensive bid you're seeing in the market has historically reflected in NVIDIA. What's going on in Europe?
Right, yeah. First Republic Bank, a move of 0.25%. That doesn't sound much in recent banking move terms, does it? I'll show you some bigger moves in the banking sector, and they're happening right here in Europe this morning. This is the picture for overall equities then, down by 1.2% on the Stocks Europe 600. The banking sector is the weakest sector this morning, down by 3.4%. We've seen a downgrade to Deutsche Bank. We see their CDS just creeping up a little bit this morning. So there's a focus there on what's happening with the rest of the banking sector. And as I say, it is the weakest sector for Europe today. Outside banking, but in financial services, the way that these sectors fall, UBS Group is down by just shy of 5%. So a drop at the start of trade. Was that what led to some of the weakness we've seen in the euro? There could be a link there, some suggesting that might be what's going on. A little bit of repositioning away from risk assets as we head into the weekend is the line coming from our colleagues on the Markets Live blog. So certainly a lot to watch. Further weakness in the banking sector, a key focus for us. We talked about the Eurozone PMI data that broke half an hour ago, Chrissy. We've just got the UK part of that. UK manufacturing PMI coming in at 48. The forecast was for 49.7. So once again, we see the manufacturing side of things disappointing. That was the story for the individual parts of the Eurozone and for the Eurozone picture as a whole. The services side, UK March services PMI falling to 52.8 against a forecast of 53. So just like in the Eurozone, in expansion territory, but unlike in the Eurozone, that number weaker for the UK than had been expected. And so do we see any movement on the pound? Well, we had seen a weaker pound ahead of that number. We got retail sales numbers out a little bit earlier on the UK economy. They were actually better than had been expected, even if still relatively subdued. We don't see a great deal of market action in a market that's dominated perhaps, Chrissy, by a stronger dollar this morning.
Yeah, and it'll be interesting to see what that ACO data has a reflection on when it comes to the yield picture, because I got to say, Anna, one of the things that is mind-boggling to me is what is going on in this bond market. Who better to perhaps clarify things for me than Henrietta Pacment, head of global fixed income at Allspring Global Investments. Henrietta, a pleasure to have you on the show. Let's start with the front end of the U.S. Treasury curve, if we can. To what extent is it pricing in cuts, and to what extent are we going to see it go back to 4% on the two-year yield?
So I think there's been a big change given the volatility that we've seen over the past 10 days or so, and some of the noise that we've been seeing in the financial sector, particularly in the US. So I think the moves that we're seeing there are a reflection of that, and the fact that the Fed is going to get a bit of help in its battle against inflation, as we expect credit conditions to tighten given the volatility we're seeing in the financial market, particularly in the regional banks.
Okay, we're certainly focused on credit conditions, watching that data then very closely, Henrietta. I wonder what else you're watching. We've got a chart that shows the Fed Foreign Central Bank's facility that was tapped for $60 billion, and there's been no information provided as to who accessed that repo facility. Of course, we know about where the stress in the central bank in the banking sector has been of late, and so we can only ask and we can only wonder. But is it this kind of data set that's worrying for you?
I think these are all the sort of pipes that we're looking at the moment to make sure that things are working as intended. And it's been very interesting to see what the central banks have done in terms of their latest rate hikes. They've tried to dissociate what they're doing in terms of their hiking cycle with the conditions in the financial markets. We think that makes sense, but it's still, we're thoughtful, and we're keeping an eye out on any metrics that may show signs of stress in the piping of the banking system.
Yes, indeed. And with that in mind, I mean, some people point out to me that it is the regional banks, it is the smaller banks in the US that do a lot of the lending to business and to individuals in the United States. And so are you keeping an eye on credit availability? Is that essentially the key factor here as to whether we see a pullback in credit availability? That will do some of the Fed's job for it, or we don't?
Precisely. And I think, our thoughts is that this is going to help the Fed in its fight against inflation. So it's a careful balance to strike going forwards. But yes, it is going in that direction. It should help slow growth, which is what they're looking for, and in time as well continue to help getting inflation down.
I've heard some people throw around the phrase credit crunch. I mean, that sends shivers down your spine because it has echoes of 2008. But where do you see a divide between the two phenomena?
I do think we're in a different situation to what we saw in 2008. However, we are looking, as I mentioned, in terms of credit conditions, and that is likely to feed into fundamentals in certain areas of the market. And that's what the central banks are looking for. But it is, a tight path to strike at this point.
So that credit crunch here, Henrietta, put a time frame on it. Are we going to see it align with perhaps some of the recessionary calls or the rate cut calls in the back half of the year? Or is this kind of an isolated event, given that it's not a systemic risk, it's not 2008, as you point out?
It's going to be interesting to see. I mean, you've got a few factors coming together at this point. Rate hikes do work with a delay, call it 12 to 18 months. We're getting there. Towards the middle of the year, we will be in that time frame where we should be seeing more impact of the rate hikes that we've seen so far. It's been a very fast hiking cycle as well, be it in the European side or the US side. So it is starting to have consequences, and it's starting to shake out some of the more fragile areas. We had the LDI crisis in the UK. Now we have the sort of noise on the regional banks. That's what we're expecting, a bit of a shakeout at this point. We need to see how it feeds into the economy. And if you look at the numbers, even out of Europe at the moment, yes, a bit more weakness on the manufacturing side, but services still coming in strong. That's also the case in the US, and that's where we need to see more of a turn in terms of inflation as well.
So Henrietta, then, if the banking turmoil is to some extent doing the work of the Federal Reserve and other central banks for it in terms of those kind of potential credit crunch ramifications, in terms of that policy lag that you just mentioned, is that a faster or slower effect to read through into the economy relative to a rate hike?
I think they're linked, right? We're going to see the sort of feeding through of those rate hikes into the economy continue and accelerate over the next few weeks, over the next few months. So I think further rate hikes, we're closer to the inflection point. When we talk to our strategists, that's the way they like to term it. Particularly in the US, particularly in the UK, and to a degree as well in Europe. That being said, I'd say that some of the turn on the inflation data is maybe a little delayed compared to those geographies in the European zone.
Henrietta, thank you very much. Thanks for your time. Henrietta Pacman of Allspring Global Investments joining us on set here in London. Coming up, we will talk about TikTok. The CEO of TikTok defending the app to a fairly hostile Congress. We'll discuss with Lindsay Gorman, Senior Fellow for Emerging Technologies at the German Marshall Fund's Alliance for Securing Democracy. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
and they sell when the prices go down?
Yes, or yes. Not keeping, look, people have conviction, or they invest for the, if they invest for the right reasons, just keep at it.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
I have seen no evidence that the Chinese government has access to that data. They have never asked us. We have not provided.
Well, you know what? I find that actually preposterous.
I have looked in. I have seen no evidence of this happening. And in order to assure everybody here and all our users, our commitment is to move the data into the United States to be stored on American soil by an American company, overseen by American personnel.
That was the TikTok CEO Shou Chew testifying before a U.S. House committee yesterday. Chew was grilled by members of both parties on Chinese control of the social media site's content. U.S. lawmakers are weighing how to force the parent company to sell its share of TikTok or face a possible ban. Joining us now to discuss from Washington is Lindsay Gorman, Senior Fellow for Emerging Technologies at the German Marshall Fund's Alliance for Securing Democracy and a former White House advisor. Also with us, Mandeep Singh, Bloomberg Intelligence Senior Technology Analyst. Lindsay, if I could come to you first. I mean, the headline from this, do you now see a path for TikTok in the United States that avoids either a ban or severe restriction on its operation, given what we saw on display in Washington yesterday?
Well, I think that at this point, TikTok's goose may be cooked in the United States in terms of any possible action to allow it to continue as business as usual. Right now, there are several possible paths on the table, and I think where Congress and the administration may be heading is towards requiring a forced divestiture of the app from its Chinese parent company, ByteDance. Now, for the average American, that might not actually affect TikTok's operations all that much because users would still be able to use the platform. And one of the really strong talking points that Shou Chew mentioned yesterday was appealing to TikTok's extremely large creator base and user base of 150 million Americans. He said that's almost half the country, which is obviously enormous. So any action is going to have impacts, but I think policymakers who some themselves are on TikTok will be looking for an option that mitigates that impact into the average user.
Yeah, Mandeep, we heard a lot yesterday from the conversation in Washington that was focused on the extent to which there is a firewall or not between US user data and the Chinese Communist Party. And that's basically what a lot of the 4.5-hour conversation came down to. Is there anything that TikTok could say? I mean, we talked a lot about Project Texas, which is supposed to go some way to providing that firewall. Is there anything further that the company could do to reassure US lawmakers here?
I think they talked about, TikTok having a global R&D and, sharing data with, the folks who are probably in China. And that's where it becomes hard to decouple the operations, because when you have a global parent company, and that is what's driving a lot of the innovation on the algorithm side, the reason why TikTok is so good is because of its content recommendation. And I don't think they're willing to share that in terms of, the algorithm or what is behind it. And that will become a sticking point, I think. And a lot of the discussion yesterday was around that aspect, that are they willing to share their proprietary algorithm with and divest it completely?
Mandeep, social media is no stranger to scrutiny from the government as well. Talk to us about the read-through you're getting into other social media companies like Snap, like Meta, like Pinterest even.
Yeah, so we did a proprietary survey, and it was clear that YouTube is probably one of the biggest beneficiaries, both in terms of users as well as creators, because they have a revenue sharing model. Meta is close second, with Facebook and Instagram. And then, we were surprised by Netflix actually benefiting because their content recommendation is so good. So it's all about where users spend their time. Obviously, a lot of the small businesses have built their business on TikTok and Meta, and so they can move to Netflix. But when it comes to the users, they will move their viewing habits on platforms outside of social media, which would include streaming as well.
Lindsay, hop back on in here and talk to us about the read-through here for American tech from a geopolitical perspective. Now that you have TikTok under such scrutiny in Congress, does that sort of incentivize another wave of scrutiny on those social media companies that Mandeep just outlined?
I think it may. And one of the things that was so surprising and encouraging to me at the hearing yesterday was just how bipartisan in nature the calls and really the scrutiny of TikTok was, but also the calls for broader technology regulation. This is something that lawmakers have been talking about in Congress for 5 years now, ever since Mark Zuckerberg first testified before Congress in 2018. And for the first time, we really saw bipartisan calls for things like federal data privacy legislation that would apply to all social media platforms. But I do think there's something unique about TikTok here. And as Mandeep said earlier, there was really a disconnect between what TikTok was saying with the potential to firewall off data and what lawmakers were really grilling him on, because what he was saying is it's not about ownership, it's about this oversight. And essentially the questions that lawmakers were asking actually went right to the very heart of TikTok's ownership, precisely by its parent company ByteDance, asking about those financial ties, whether the CEO himself receives compensation from a Chinese company, whether his employees do. So I think these have broader implications for the business community and CEOs who have ties to China, who have these very complex multinational geopolitical operations, that we all need to be thinking about our relationships with China when we're doing business now, because U.S. lawmakers are on alert.
Yeah, it felt like there were two wider stories here, way beyond TikTok, Lindsay. One was the wider regulation of social media and some of the things that were being leveled at TikTok, you know, as the CEO said, could be leveled at other social media businesses in the US. But the other was the whole cooperation across border to manufacture, to make things. And we saw the CEO of TikTok talking about the cooperative way that certain things were produced and trying to draw parallels with other US businesses. I suppose then there will be US businesses asking themselves once again about their links with China for manufacturing or other parts of their supply chain.
Absolutely, particularly as regards China's possible human rights abuses with its Uyghur Muslims. That's an issue that Congress and the administration have been really hammering on and making sure that our supply chains are not inadvertently feeding China's surveillance state and China's human rights abuses. This whole conception of ESG, environmental, social, and governance that businesses have been accustomed to dealing with when it comes to climate risk and other ESG topics really is going to take on this new dimension of human rights when it comes to China. So I think this does apply to all businesses. Obviously, TikTok is an anomaly in the sense that it has that ownership tie to China, but also TikTok won't be the last social media platform that comes from China. It won't be the last popular technology company that comes from China. It's not the first, it won't be the last. And so my hope is that policymakers put some stronger guardrails in place, if for no other reason that businesses can know what to expect when they're developing these operations.
Mandeep, I'll give you the final word here. 60 seconds. Talk to us about just the valuation on TikTok itself.
Yeah, so when we look at the overall revenue, it's closer to 16 to 20 billion, and US is probably half of their revenue. And when you use the current social media multiples, we arrived at a $40 to $50 billion valuation. It's somewhat of a discount for the fastest growing social media asset because of all the regulatory concerns. And look, with this consumer internet apps, they're worth zero if they lose engagement. And that's the risk with TikTok. If it gets banned to a potential buyer, once the users move away out of the platform, it's not worth anything. And I think that's where you have to put a discount. And we arrived at that $40 to $50 billion valuation for a willing buyer, which could be Oracle, Microsoft, or a consortium of private equity based on our expectations.
Okay, thank you both. Thank you both for your time. Really good conversation. Lindsay Gorman of the German Marshall Fund and Mandeep Singh of Bloomberg Intelligence. Thank you both for joining us. As we were having that conversation, further developments on the European banking story. We've been talking all morning about how we see weakness in European banking, and once again, that is weighing on the European stock story. Let's focus in on what we're seeing there, because Deutsche Bank certainly to the forefront here. It is the worst performing of these banks this morning. Deutsche Bank down by 11.1%, as you can see, intraday. What is driving this? Well, some of our colleagues linking the moves we're seeing in CDS here and suggesting we've seen a spike up in CDS. Deutsche Bank shares slumping as CDS jumps. So this is the cost of insuring against default over at Deutsche Bank. As we head into the weekend, a sense that investors are trying to de-risk portfolios perhaps and wary of what can happen over weekends, as we've seen over recent ones. And we're seeing this in FX markets as well. So the dollar is gaining, the euro is losing ground, the yen is gaining, the pound is losing ground. So we're pretty risk off this morning as we look to hand over to the United States. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Welcome back to Bloomberg Surveillance Early Edition. A real focus on de-risking, it seems, here in Europe. Deutsche Bank extending its drop. That stock down 11.1%. Criti Commerzbank also down 8%. SocGen over in France down by 6.5%. Colleagues talking about businesses that are exposed to corporate lending here being in the focus.
Yeah, you're seeing it in the stock, you're seeing it in the credit default swap, specifically the 5-year surging there, and in the FX space, a read through into the macro as well. The euro, Anna, at a 107 handle, weakening as we speak.
Yeah, and some of these European equity markets now down by more than 2%. The CAC 40 down by 2%. The Xetra DAX in Germany down by just shy of that amount as we work our way towards the start of US trading. That is it for Early Edition. Surveillance is ahead. This is Bloomberg.
Chris, can I ask my landlord for a rent cut in the next couple months? Like, is that reasonable?
Well, I guess it depends when you signed your lease, Joe. It sounded like you got kind of one of those pandemic deals that, particularly in New York City, where rents actually fell really sharply in that first year of the pandemic. So we are really seeing the market having turned a corner a little bit over these past few months. Prices have been coming down for 4 straight months now in our national rent index. But, if you're still paying that late 2020 level, then you might not necessarily be eligible for a discount at this point.
Good point.
All right, I have another question, which is like, so I have 2 kids, but unlike other people, I actually am cool and I don't want to move to the suburbs. Like,
this episode is just Joe taking like advice on handling his rent.
I just want to point out, I really like my landlord.
You love your landlord?
She's very attentive. We have a very good relationship. So even though I started the episode saying I was anxious, if she is listening to this, I hope she hears that I really enjoy where we live and I really enjoy our the landlord.
She should factor your consistency into her pricing algorithm.
We've never been. Yes, exactly.
Excellent.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Inflation is sticky. The Fed has to do something. Its credibility is still on the line.
We don't think that there is a material risk of broad-based challenges. Instead, we've been calling for this bumpy landing.
What matters and what actually shocks my economic and inflation models is how fast they cut and when they start cutting.
The market has anticipated a lot of rate cuts this year. Our economist still thinks it's off in the future.
The Fed is going to be on hold until inflation gets down to something much closer to 2%, and that's, I think, going to take a while.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I've forgotten what day it is. Totally.
It's
like
Monday.
every single morning.
Of next week.
It's Sunday evening, cliff edge. It's sort of never ending. Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance. Reliably informed. It's Friday, almost getting into the weekend. Equity futures down about 0.75%. Some European banking names struggling to get to the weekend. Here, Deutsche Bank, Lisa, down 12%. Over in German trading, UBS is down about 6%. No drama relative to the action we've seen over the last, say, 2 weeks or so. 6% is kind of like unchanged relative to what we have witnessed, but still pretty dicey stuff for some of these names.
Especially because it's not just in the stock price. You're also seeing this in the credit default swaps, what people are charging to insure against a potential default surging for Deutsche Bank in particular. At what point does this indicate that we're not out of the woods? And I think that this is the larger concern. There have been all these measures, all of these officials coming out and saying, all is clear, the banking system is sound and resilient, and yet still those jitters are being reflected in market prices.
Secretary Yellen, I think it was her 50th appearance in like 2 days.
Yes.
Finding a new way, a different way to say the same thing. You know, that's been the last couple of weeks for her. I felt really bad for the Treasury Secretary over the last couple of weeks. Almost left to sort of hang out to dry, lamb for slaughter in the eyes of an administration that we haven't really heard much from, apart from a statement after Sunday evening.
I would completely agree because there are certain things that are not in her purview. She cannot do single-handedly, and it was very clear from the hearings in the House yesterday that a lot of the politicians were not interested in talking about deposit insurance. They weren't talking about long-standing solutions. They still wanted to talk about the budget and the debt ceiling and all these other issues. So without their political will, how much can she say? She did amend her statement, though. She made this change. She added, certainly we would be prepared to take additional actions if warranted. It didn't work, though.
No, of course not. What does that mean?
Yeah.
It's the same thing she said all over again and again and again.
What else can she say?
Nothing.
But that's the issue, right?
But she's in front of the individuals that can make legislation to change
Correct.
the cap. That doesn't make sense to me. So why are we criticizing the Treasury Secretary when the individuals who are questioning her are the ones that should be making legislation.
I couldn't agree more, especially because had she come out and said, what we need right now is full deposit backstops, you guys have to get on board with that, that would absolutely cause panic in markets. Why is suddenly this needed? Why is she lobbying so hard for this at a time when people are saying the system is safe and sound? So either way, it's, damned if you do, damned if you don't.
Let's get you to the weekend. The price action looks like this on the S&P 500, down about 0.7%. Let's call it down 0.6% on the S&P 500. Still poised for a second week of gains. Yes, really, 2 weeks of banking turmoil and poised for a second week of gains on the S&P 500. Yields are down aggressively by 12 basis points, 330 on a US 10-year. The 2-year yield is down another 20 basis points on the 2-year. The 2-year right now, 362. So that's basically near the lows of the week, 362.83. In fact, that takes out the lows of the week, Lisa. Just remarkable stuff to see the 2-year down here. Briefly, 361. So yesterday we were down 10 basis points. The day before that, we were down 23 basis points, and we're dropping pretty aggressively this morning.
And when you take a look at what people are expecting in terms of rate cuts, they are now pricing in 120 basis points, 1.2 percentage points of cuts through the end of January next year. So it just shows you how much the scenario has changed. We have been asking all week, when does the economic data matter? And we continue to say all week, it's all backward looking, at least until it's not. And right now, we are going to get some economic data, and people will tell you why it doesn't matter. However, I am going to be interested to see what the U.S. durable goods orders are. That comes out at 8:30 a.m. And what you saw, building on what we saw over in Europe, was ongoing strain in the goods sector, disinflation there, and ongoing upside surprises in the inflation and activity on the services. How much do we continue to see this? Do we start to see some softening in terms of the durable goods orders? And do we start to see some recovery at a time when perhaps interest rates are going down? It's just a jumble, but it is relevant. 9:30 a.m., we hear from St. Louis Fed President James Bullard. Over to you. Did something break? We're looking at that 2-year yield and the round trip, the fact that now they're the lowest going back to September of last year. Has something shifted materially that Fed officials can point to and say, hey, markets, we got you, we see you, we understand what you're saying, and we will reflect that? Or are they going to continue to try to push back, I would say, and argue potentially to no avail? Today, bids are due for the Silicon Valley Bank, either in its entirety or in parts. Evidently, there is some deal with Customers Bank Corp that's being discussed for some or part of some or all of the bank. The fact that the FDIC pushed back the bids, they're due today, and they had originally been due, I believe, last week. The fact that they did that has raised some questions. Does nobody want a bid? Did they want a better bid? Did they want more time to look under the hood and to understand what the liabilities were that they were taking on? I think that's going to be interesting to parse out.
Do they like the people who are bidding? Are you raising that question too?
Sure, always.
Where the bids are coming from?
Whether they want it to be a big bank, whether they want it to be another kind of local,
Precisely.
regional, whether they want a consolidation of the middle rather
Not
than just
private equity.
Well, yes, that's another thing, right? They don't want that to be the case because they want it to look good and feel good, and regionals getting
this
together.
This is going to look good and feel good. What is this therapy?
Every day. It's Friday
Feels
after
that
a
way.
long
I
week.
know.
Let's
with you.
talk about our feelings.
I feel for Secretary Yellen in a big way. She found a new way to say the same thing. Take a listen.
As I've said, we have used important tools to act quickly to prevent contagion, and they are tools we could use again. The strong actions we have taken ensure that Americans' deposits are safe. Certainly, we would be prepared to take additional actions if warranted.
That's the new line. I'm not sure how different it is. Chris Marangi joins us now, co-CIO at Gabelli Funds. Chris, your words, the bank crisis, a feature, not a bug of Fed policy. Chris, what do you mean by that?
Well, listen, I think we've talked for a long time about Chair Powell pushing rates until something breaks, and clearly something is broken. He's made he hasn't been shy about talking about the fact that this credit crisis is going to be disinflationary. It helps him attack inflation. So as long as we can manage through this, it probably helps that part of the equation.
If we can manage through it, if we can avoid a deeper crisis, one that spreads even more, Chris, is this sector attractive to you in any way, shape or form?
Well, thankfully, we have generally avoided we've generally avoided commoditized businesses, and the borrow short, lend long business is somewhat commoditized. And it's become less attractive recently, in part because funding costs are going to go up. Banks are going to have to pay more for deposits. Credit quality is likely deteriorating. There's going to be fewer loans, so fewer revenue opportunities. and almost certainly more regulation, including higher credit standards, higher ratios required. And that's going to impact both the P and the E for these stocks. And so they're less attractive, not something I'd want to get involved with today.
I feel like this market's been exerting the maximal pain on the maximal number of traders at all times. Heading into this year, people were talking about value stocks and how banks fit into that and how big tech was going to be left for dead. Big tech has ripped. Banks are having trouble. At this point, do you still think that big tech can lead, given the concerns around growth, given the concerns that perhaps the cost cutting and the potential right sizing of the businesses is not over?
Yeah, I would make a distinction about, obviously there's been this rotation back to tech, back to growth. I think much of that is related to a safe haven trade. Investors looking for these big nation state type companies with big credit balances, cash flowing businesses as a safe place to be. Small tech, profitless tech has not shared in as much in this rotation, and a higher interest rate environment, a recessionary environment, is not going to be good for those companies. So, we're still looking for the cash flow generators, companies with pricing power, and that's been the formula for a recessionary environment, for an inflationary environment.
We started this conversation, Chris, talking about the Fed hiking rates until something breaks, and something clearly has broken, as you said. I'm curious what that means about the way you invest in terms of, do you go for diversification or do you go for further concentration in the companies that you know best?
Yeah, I mean, we're obviously looking for diversification across both industries and companies, but it's to a certain extent we want to focus on our core competencies. We want to put our eggs in a basket and watch that basket, and that's basically what we've been doing unchanged for 40 years.
Chris, are we sleepwalking into a crisis, a much bigger one?
I don't think I'm certainly not sleepwalking, and I don't think the market is as well. The market is well aware of what's going on, and maybe a little bit too nervous given the recency for many of us of the 07-08 crisis. Obviously, lots of risks out there, and that's what we get paid to manage.
Do you think that breeds complacency, though? Those that have experienced 07-08 who always sit there and say it's not 07-08, Chris?
It's always a little bit different, and clearly this time is different. I don't think we have quite the systemic issues in the banking system that we did back then. Obviously, the Fed now, having raised rates so aggressively, does have some ammunition, some dry powder to obviously cut rates and improve the situation. But it's what you don't know that you worry about.
Totally, and there's so much we don't know. Chris, we've got to leave it there. Thank you, sir. Chris Marangi there of Gabelli Funds. Lisa, there's tons we don't know still.
The issue that I've been taking with a lot of what people are saying is this is a liquidity issue, not a credit issue. Well, liquidity issues always lead to credit issues if they're long enough.
Sure.
I mean, this is the issue. It happened back in 2007 with the commercial paper market, back in the asset-backed commercial paper market in Canada, that sort of, some people argue, triggered all of the subsequent events. So at what point are we looking at some seizure in lending that creates the credit problems that aren't being priced into the market? I'm not saying that's going to happen, but I just take issue with people who are trying to draw too clean of a distinction here, because the two are deeply interrelated.
Blaming Canada this morning. That's new. That's good. People waking up in America, feeling very good about that.
Well, I mean, look.
Ramo's blaming Canada.
Well, I mean, that's where Joe Biden is. So I guess, look, I'm not blaming Canada. Just to be very clear. Come on.
Just winding you up. I know. You're tired from a long week.
Yeah,
Mike Aben of Bank of America. Downside risk to spending could grow if the banking sector stress causes a sharp tightening in lending standards. That's his line in his research in the last 24 hours. Lisa, I think that speaks precisely to what you're talking about.
Yeah, this is going to be the issue. And this is the reason why people say that no matter what happens, there's going to be more distress. Is it being priced in? I don't know, because if rates go lower and people have priced, the parameters of uncertainty are great. It's just that drawing a distinction between liquidity and credit issues, difficult for me to stomach, given the fact that those are two so interrelated.
Give it a few more days. Those treasuries on those banks' balance sheets won't be underwater anymore. 2-year yields running so hard, we're down 25 basis points.
The second that they aren't underwater again, let's start the whole narrative over again, and we're back to runaway inflation.
Can we talk about a TikTok CEO later?
Yes, please.
What a slick dude. Seriously, how polished.
Except, when they asked him, is this spying? And he's like, I wouldn't call it spying exactly.
Sure,
and
but
the whole thing was just like,
just picture the scene. Everyone hates you. They're all throwing aggressive questions at you. I thought he dealt with them very well. And then we can talk about what it ultimately means for the company, because I don't think he helped the company at all. But
he looks good.
He's a pretty slick dude.
It's TikTok.
Next hour, Trogarski is going to be joining us from FS Investments.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. U.S. prosecutors have charged Terraform Labs co-founder Do Kwon with orchestrating a massive cryptocurrency fraud. It's said to have wiped out at least $40 billion in market value. Kwon was already a fugitive from charges in his native South Korea. He was arrested Thursday in Montenegro. In Japan, inflation slowed for the first time in more than a year. Consumer prices, excluding fresh food, rose 3.1% in February from a year ago, down more than a full percentage point. But without the impact of government subsidies for energy and travel, inflation would have been as high as 4.4%. Treasury Secretary Janet Yellen says regulators are prepared to take more steps if needed to protect the banking system. Those comments to Congress came a day after her remarks on nationwide deposit insurance that rattled markets. On Wednesday, Yellen said officials hadn't considered the possibility of expanding federal insurance temporarily to U.S. bank deposits. And China is urging Europe to play a role in supporting peace talks for Russia's war in Ukraine. That's despite the U.S. warning that Beijing's proposals would effectively freeze the Kremlin's territorial gains. China's top diplomat spoke to a French official about the peace plan not long after Xi Jinping wrapped up meeting with Vladimir Putin in Moscow. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
News breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of three very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
I hope we're through the worst, and I think there's still some questions around business models around the world. Have there been weaknesses that have been exposed in the business models of any of the companies that have had trouble that need to be addressed at this point? But it certainly seems that the acute phase of the crisis is done.
That's what everyone hopes, right? That was Bill Winters there, the Standard Chartered CEO. UBS is down 7% today. The latest story here at Bloomberg is there might be a DOJ probe into Credit Suisse, UBS, and some other names as well. Lisa, associated with helping Russian oligarchs evade sanctions. Now, on Sunday evening, you and I and the whole team were talking about this government guarantee. Sometimes you inherit legal problems when you make an acquisition like this, and maybe one is already brewing.
That was a speculation under the hood in terms of what took so long for UBS to sign off, and it took so long, I should say, is days and hours rather than weeks and weeks. But the question really being, why do they demand such incredible concessions from the Swiss government unless they saw something under the hood that they didn't like?
There's lots of complaints about what happened over the weekend. One of Credit Suisse's biggest shareholder groups weighing in on UBS's rescue of its Swiss rival earlier this week. Vincent Kaufmann, the CEO of Ethos Foundation, saying the following: "This situation is a big failure of corporate governance and may send a poor image of Switzerland for international institutional investors in terms of good governance." Vincent, I'm pleased to say, joins us right now. Vincent, fantastic to catch up with you, sir. I guess the first question is, how much room do you think you have for legal action here?
Very small. Actually, very small. You know, in Switzerland, we don't know the concept of class action. That doesn't exist in our law. Mismanagement, it's very difficult. We could never use this in the UBS case, or even in the collapse of Swissair in the years back 2000, while there was clearly mismanagement. So either against former executives of Credit Suisse or the decision of the Federal Council, there is really little to be done. We're still looking at options, but at the end of this week, after having discussed with many people, we don't see many options. We will still recommend at the next general meeting of Credit Suisse not to grant a discharge to the board, to keep all options open. If anything is revealed afterwards, as you said, there is a lot of still uncertainty, so we really recommend shareholders not to grant a discharge to the board of directors of Credit Suisse.
Hard to know the counterfactuals, sir, but just to cut in, what do you think would have happened Monday morning if this deal wasn't made?
We will never know. We will never know, but I trust the Swiss government that they reached this decision as they was aware of things that we didn't know. So I could clearly expect the similar crisis as in 2008. I would have expected the Lehman Brothers case, and then the start of a really big crisis. So is it just a postponement, or can we manage to avoid this? Still to be seen. But yeah, obviously, if the government acted this way, they knew things which, yeah. I still have belief and trust in our government that they reach a good decision.
Do you have any reason to suspect that you were not given accurate information about the condition the bank was in over the last couple of weeks?
I mean, the latest information we had was financial year and 2022. The annual report had just been released, so we already had the interim financial Q4 result. But as you know, the full report was postponed by 1 week following SEC request. So the board was really quite quiet, saying it's nothing material, it's just reclass and so on. But still, then the auditor and the management said about material weaknesses. So we only had the information of financial year and on Tuesday, I think. But I think the situation collapsed during the first quarter. So we don't really have any further information about the outflows. We know that it was about 10 billion per day from the statement of the Saudi National Bank on the Wednesday. So obviously there was big outflows, but we will never know. I think we will never have the clear figures that the government had on Saturday.
Vincent, I'm curious from your perspective, given that you do talk to other shareholders, you represent them, what this does to Swiss companies going forward in terms of their credibility, the risk premia that people want to bake in to whatever they own from Switzerland.
Yeah, I think it's we had made big progress, I would say, in terms of corporate governance in Switzerland, being on shareholder rights. We have a lot of rights. We are advancing also in terms of sustainability. So I think we were on a good move, and the fact that, yeah, the government now decided that shareholders would not have any say on this, that also the antitrust authorities will have no say on this. I think it's quite dangerous for the future. I hope it doesn't create a precedent that the government is overusing this power. So we will be very looking at this precisely in the future. So obviously, when you remove such important right to shareholders, you need to have good reason, very good reason. Otherwise, yeah, it's quite catastrophic in terms of governance.
So far,
I'm not sure it's been seen already in the corporate world, those kind of decisions.
Right, Vincent, and I want to pick up on what you said, which is if this happens again, if this sets a precedent, then there could be consequences. Have you already talked with shareholders? Have you already talked with investors who are removing some of their funds from certain Swiss shares just because of the uncertainty, because there potentially could be better options elsewhere?
No, honestly, no. I didn't hear anything on this one from international investor. I think, many investors are still quite passive investors, so replicating indices. So that's still the main part. So as long as we have a large cap being part of those indices, I think the international institutional investor will always have those exposure. And we have wonderful, actually, industries and companies in Switzerland being leaders of their market. So in terms of mid and small cap, we have such a wonderful corporate field. But I think we need to ensure that the governance of those companies remains at the highest level, because, of course, all investors now are looking at those environmental, social, and governance. I think governance is coming back at the front of the scene. We were talking about environmental issues, very important, but you need to have a strong governance basis. And those failures, being in the US, being in Switzerland now, demonstrate that governance maybe was underlooked by investors. So for us, it's key that the governance mechanism works, that shareholders' rights are preserved for the future.
Vincent, thanks for joining us today. Vincent Kaufman there of Ethos, a shareholder group representing shareholders of Credit Suisse. A difficult week, long week for him. Anyway, no shareholder vote. The Swiss came in. You saw the complaints, that quote we talked about earlier this week. What's the difference between Switzerland and other jurisdictions where you don't trust the rule of law? Just like that. Changed it over the weekend.
So one of the big questions has been the consequences of this, the long-standing consequences of this. And Vincent basically suggested that so far people aren't willing to wholesale abandon Swiss holdings as a result of this particular ruling. That said, there have been a number of articles about Middle Eastern investors. This had been their first full significant foray back into the banking system since 2008, when they made this capital infusion into Credit Suisse. Now, perhaps not as interested in investing in some of the banking stocks around the world. So again, you wonder, there have to be consequences, whether it's the contingent capital market or whether there's something much broader that really makes people rethink where they put their money.
Let's talk about policy consequences right now. 2-year yield down 22 basis points. We priced it in a cut by June now. Is that the latest?
That is the latest.
Cut by June.
Yep, and people are looking at that just to be the beginning of a series of cuts. It's not only one cut, it is a rate cutting cycle that we are now pricing in.
There you go. Market's saying you're done. Screaming you're done. And you're going to start cutting interest rates.
Market's screaming you're done. And by the way, maybe you made a mistake, Jay Powell. I mean, that's been sort of the latest that we're hearing in the mood this morning. Perhaps you shouldn't have raised rates at all. I think it's really tricky. I think that he was going to be blamed no matter what he did. And I think that he did. He towed the line very nicely. Just uncertain right now.
History will judge whether that move this week was Trichet or Volcker. It'll either look really foolish in months to come, or it will look like it was the right thing to do, and that's why those kind of decisions are impossible to make. It's a super hard decision. Futures down 0.7%. From New York, this is Bloomberg.
governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Getting some fascinating comments from the Bundesbank president this morning. The chief of the German central bank will keep raising rates for as long as needed because of inflation. Lisa, we'd welcome a speeding up of QT in 3Q. That is a pretty hawkish central bank right now, right?
Well, especially given the backdrop. I mean, right now, given the fact that people are pricing in cuts in the U.S. and that all around the world, suddenly perhaps the rate hiking cycle is over. The fact that you get hawkish comments like that, really telling. On the flip side, are people buying it? Take a look at that German two-year yield. It's tanking like a stone. You could see it down to 2.27% from as high as 3.3% on March 8th, that pivotal moment. So maybe he's just, you know, making a lot of noise and people are just kind of like, nah.
Deutsche Bank's down 12%. This Fed's saying we're not going to cut. And look what's happening in the bond market. Let's whip through it. Equities are lower on the S&P 500. We were poised for a second week of gains. Might wipe that out at the opening bell if this continues. We're down about 0.8% on the S&P. On the Nasdaq, we're down 0.5%. You're familiar with the weightings on the Russell, the small caps, a tilt towards the financials in a way that the Nasdaq does not have that tilt. The Russell is negative by more than 1%. In the bond market, Lisa mentioned it, yields dropping like a stone. 2-year. Lisa, down 22 basis points. Think of the move yesterday on top of that, the move the day before on top of that.
I just look at that chart and I keep thinking March 8th, when we saw that peak of more than 5% for the 2-year, coming all the way down to 3.6%, something broke. And that is the only way to understand this chart. Why are Fed officials, why are central bankers in Europe not reflecting that? And if we're wrong, what's going to give confidence to the market that no, nothing is broken, you guys are just histrionic?
Do you want the high from Wednesday? High of the session Wednesday, 425. That's 2 days ago. 425.
Again, this is the most liquid, most used benchmark in the world in terms of the bond market. When you look at U.S. Treasuries, the fact that you see yields jumping around to this degree, what does that tell you about where we are and how wide the parameters of outcomes are?
Euro dollar down about 0.9%. The euro against the US dollar, 107.31. That's a weaker euro. Stronger dollar in the mix. That hasn't been the story of the last week. So the dollar, Lisa, kicking back in as well.
It's the haven trade as people get worried about the banks. How much are people pitting European banks versus U.S. banks and then making a currency call on it? Seriously, because that's essentially what seems to be happening. You can't explain it by divergence in monetary policy because that would be supportive of the euro.
We'll keep you up to speed on what's happening with Deutsche Bank as well. The stock's down about 13%. Got to say, no news, no real news in the last 24 hours for this name. UBS is down about 7 or 8%. There is some news there. They might get caught up in a DOJ probe, and who knows how that turns out. We know that those fines can be pretty hefty.
They can be hefty. They can also create some reputational risk at a time when they were really solidifying the reputation in a much more concrete way. You're right. There is no news. Deutsche Bank, in fact, buying back some of their subordinated bonds to try to fortify their balance sheet. This should be positive, I would think. I don't understand unless there just are people looking at potential counterparty risk, or I don't want to spread rumors, but what would cause this? And maybe people just pile on.
Was there anything positive about this? Take a listen to the TikTok CEO in front of Congress on Capitol Hill in front of a House committee. Take a listen.
I have seen no evidence that the Chinese government has access to that data. They have never asked us. We have not provided.
Well, you know what? I find that actually preposterous.
I have looked in, I have seen no evidence of this happening. And in order to assure everybody here and all our users, our commitment is to move the data into the United States to be stored on American soil by an American company, overseen by American personnel.
Clearly nothing he said yesterday was going to be sufficient. So here it is. Let's make it really, really simple. He can't change their minds. They don't like the plan he has to protect and store data here in the United States. They clearly don't trust this company. So I would say this, the longer they do this with the TikTok CEO, the more foolish the representatives of Congress start to look, because they need to do something about it then, and they've got to make a decision. Now, forcing a sale is the easy way out. Unfortunately, China will not allow that sale to go through. And that just agitates those who think China has the ultimate say over this company. So it becomes even more simpler than that. Ban it or don't ban it. But the longer you have these hearings without banning it, I think the more foolish the government looks, and not the TikTok CEO.
I would take that a step further and say it actually emboldens the CEO, because this is a PR move for him too. If you just clip out his responses, he looks measured and cool and trying to answer amid a firing squad. And for all of the people who are trying to say, look, he's just another executive, then he'll actually gain credibility. And on the flip side, to your point, if this is an issue of national security,
do something about
it. Very clear.
Do something about it. And clearly forced sales are not going to be allowed by China, so you're left with one option: not to ban or to ban. It's not complex, is it? It really isn't.
It gets more complicated when it's the young voters that could potentially
precisely
get really upset
and then,
that
Lisa,
you're taking their toys away.
Then it's about politics and it's not about national security.
Well, it's always about politics. Come on. Since when did you believe that things were that pure?
Look, if it's about national security, that shouldn't even be a question. We talked about this yesterday. Terry Haynes of Pangea is going to join us a little bit later. Look out for that conversation. We'll catch up with him in about 10 minutes' time. We've got a euro that's a whole lot weaker today. Euro dollar negative 0.9%. Alsa Linios joins us now, Global Head of FX Strategy at RBC. Alsa, can we just start with the price section of this morning? What do you make of what's developing at the moment?
It's so interesting, isn't it? Because we have gone up and down this week and basically back to where we were, I think, at some point on Wednesday. And it's, as you said earlier, two very different drivers pulling in opposite direction. On the one hand, you've got the rate differential, and as Lisa said, that in isolation would argue for euro dollar higher. On the other hand, when we pivot away from worrying about US banks to worrying about European banks, as markets are this morning, then that pushes euro dollar lower. What's really interesting to me, though, is that ultimately we're not going anywhere. And that realized vol in FX is a whole lot lower than it is in other asset classes at the moment. And that in itself gives rise to some interesting trades.
Also, last year, everyone was a macro investor, a macro analyst. This year, everyone is a bank analyst, or at least for the past 2 weeks. Given that, how much do you have to examine the balance sheet of banks on both sides of the Atlantic to make a currency call?
Yeah, one of my FX clients made that comment yesterday. You know, in the FX market, we're all suddenly experts on something. You know, previously it was weather balloons, and before that it was Ukrainian munitions, and now it's bank stocks. But the reality is that is what's driving our market at the moment. And you know, luckily we do have a very good team of bank analysts in-house at RBC, and they will make some points around the fact that you have a very well-regulated, well-capitalized banking sector in Europe, and that gives a lot of people a fair degree of confidence. That said, when it starts getting like it is today, you know, you see some quite large price action on the back of very little new news. It does worry people, and the euro is naturally a loser in that environment.
So how do you explain this in terms of the technicals of the market, the underpinning of the market, if there's a move that feeds on itself, that is pretty violent, that gives rise to narratives that potentially are deeply uncomfortable, but there is no logic behind it that's discernible?
So I think what's making it even trickier at the moment, and in part perhaps explains the disconnect we're seeing between rates, FX, and equities, is that you've had investors very heavily positioned in some areas, very lightly positioned in others. I think part of the reason why FX is actually not really moving that much is precisely because it's not been the key area of focus for macro investors. We had a lot of people heavily positioned in rates at the start of the year, positions getting extended further through February when everybody was sure that it was going to be a much higher, tighter, longer rating increase cycle. And now that's where you're seeing the pain as all that gets washed out. So from a currency perspective, we've actually been fairly safe and able to eke out gains on the relative value trades, on the crosses, rather than just trying to take a bet on dollar up or dollar down.
How much is the dollar going to continue acting as a haven, given the fact that what you're saying sounds like short squeezes, unwinds of trades, things that are highly specific to a market structure rather than some sort of macro event?
Yeah, it's an interesting question because it's what you would have expected to some degree this week. I mean, if we listened to Chair Powell on Wednesday, what effectively he was saying is, we can't really give you forward guidance at the moment because we can write things down in the dot plot, but the reality is it's going to be determined by facts on the ground. And those cuts that are priced by the market could be justified, but the conditions that would warrant those cuts would be pretty aggressively bad conditions. So in that kind of environment, well, what do? You buy havens, you buy the Japanese yen, the Swiss franc, the two most obvious ones, but you also buy the US dollar against risk proxies. And that's not what the market did this week. You know, we actually saw the dollar underperforming some of the riskier currencies. It doesn't make a whole load of sense. I think today we're seeing a little bit more sense return to markets where you're actually seeing the dollar start to outperform some of those riskier currencies. And in order to see that extend going forward, I think you begin to need to see it in the actual data. We'll get, you know, it'll be some time before we get the quarterly senior loan officer survey from the US, but we have some weekly indicators. I think that's what markets will be focused on going forward to take their cue.
Elsa, thank you. Elsa Lindos there of RBC. What Elsa said at the end there, I think is really important. When they say data dependent, you've got to ask dependent on what data? The senior loan survey. That's it. It's going to come down to that.
100%.
That's what everyone seems to be focused on, not CPI, not payrolls. It's lending standards in America. That's the data point going forward. I've joked it's banking stocks, but you know where I'm going when I say that.
People want to understand how much banks are restraining credit in response to some of the concerns around their balance sheet. People were also plumbing some of the Federal Reserve data that came out yesterday evening around 4:15 and 4:30 p.m. yesterday to understand the balance sheet of the Federal Reserve surging to the highest levels going back to 2021. I mean, we're just seeing a resurgence, and people want to understand why and what this means for the stress that we're seeing in the banking system.
Look at this move on a 2-year. Only a couple of weeks ago, north of 5%. Right now, 3.58. This move right now, 3.58. Take a look at 2s versus 10s. The yield curve was negative 110 basis points back on March 8th, and right now it's negative 30, and Lisa, moments ago it was negative 28. And if you take your pick on a curve right now, that's 2s 10s. Let's go 2s 30s. 2-year against the 30-year. It's now positive. It's now positive. I'll try and save the bond market jargon for you, but that is one heck of a bull steepener that's come into this bond market over the last couple of weeks, which basically means the front end leads the move. Yields aggressively lower at the front end as we start pricing in what? Cuts. The Fed said this week, median dot 23, just like the projections back in December, 5.1%. This market, one, doubts whether they can get there, and two, even if they can, they're not going to be there very long based on this market pricing.
What's interesting is also you are seeing, yes, it's a bull steepener. You are seeing this really led by the front end, but longer yields are also going lower. And so this isn't necessarily a belief that cutting rates is going to cause runaway inflation. This is a complete reset of the whole inflationary backdrop that everyone's been talking up. It's a different time. It's an inflationary regime. Now people are like, not that inflationary.
It's a secular story.
Yeah, not
and
so
now all of a
much.
sudden, this financial stress is a disinflationary shock.
For a long time.
Bob Michael at JP Morgan said every single point across the curve, 2-year out to 30-year, 3.00%. That was the call.
I'm old enough to remember when...
we're getting closer. The 10 years at 3.29.
I'm old enough to remember when people were calling for 7% 10-year yields.
That was good, wasn't it? Yeah. When was that? Last week?
Yeah, exactly.
Terry Haynes of Pangea Policy on TikTok next.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo.
UBS and Credit Suisse are among the banks being looked at in a U.S. Justice Department investigation. Authorities want to know whether finance professionals helped Russian oligarchs evade sanctions. Subpoenas also went to employees at some major U.S. banks. Credit Suisse and UBS both declined to comment. The U.S. has carried out airstrikes in Syria following a deadly attack there that killed one American contractor and wounded 5 service members. U.S. officials say a drone of Iranian origin crashed into a coalition base. According to the Pentagon, the U.S. airstrikes hit facilities linked to Iran's Islamic Revolutionary Guards. In North Korea, Kim Jong-un oversaw tests of weapons designed to deliver nuclear attacks against the U.S. and its allies. One of them was described as an underwater drone that can create a, quote, radioactive tsunami. The official North Korean news agency says the drone cruised for nearly 60 hours before detonating. The test also included cruise missiles carrying mock nuclear warheads. Billionaire bond investor Jerry Gundlach is joining the Jerome Powell is wrong chorus. The chief investment officer of DoubleLine Capital sees the Federal Reserve cutting interest rates substantially soon. And markets are signaling the Fed is wrong when it talks about the prospect for further interest rate hikes. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
From New York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg.
I have seen no evidence that the Chinese government has access to that data. They have never asked us. We have not provided.
Well, you know what?
I have asked that question.
I find that actually preposterous.
I have looked in. I have seen no evidence of this happening. And in order to assure everybody here and all our users, our commitment is to move the data into the United States to be stored on American soil by an American company, overseen by American personnel.
That was the TikTok CEO. A very, very polished, slick performance. Pretty slick dude, Lisa, I've got to say, across a number of hours, but ultimately not making a difference whatsoever. He was never going to make a difference. Nobody's mind was ever going to be changed. Terry Haynes of Pangea said this hearing, quote, isn't a debate, it's due process, completing the hearing record before beginning to legislate. Terry went on to say, and creating a prime opportunity for the TikTok CEO to compound negatively the issues that beset the app's continued use in the US. Terry, I'm pleased to say, joins us now. Terry, what did you make of that?
Well, you've never seen a better example of somebody publicly lighting themselves on fire in a congressional hearing. yesterday. The famous quote will always be the quote when asked if they used gathered data to spy on U.S. citizens. The response began, "I don't think spying is the right way to describe it." My comment on that, as you know, was, and I quote, "kaboom," in full. So what you have here is a situation where there's a lot of diversionary stuff being thrown around here, but the basics are these. You have the heads of the United States intelligence community saying publicly a couple of weeks ago to Congress that they think that TikTok itself is a national security concern because, as the FBI director said, can be used to control software on millions of devices and also drive narratives that divide Americans. The bipartisan heads of the intelligence committees, Senate and House, agree with that. You just saw how bipartisan and how strong the belief is in the lead committee in the House that does this stuff, Energy and Commerce Committee. And, so what you're going to end up with here is, I think, is not an outright ban of TikTok, but you're going to have the administration given the tools to ban, to control, whatever is necessary, TikTok and a broader swath of apps or other sorts of issues.
That seems like the direction of travel, at least over the next several months. Terry, I just wonder the option this president, this administration will ultimately choose. It feels like that a forced sale is a non-starter. The Chinese government has already said they won't allow it. Lisa and I were talking about how just that response alone agitates those who believe that the Chinese government has the final say over this company. It's just the nature of doing business in China. Terry, how do you think this story ends? Do they ban it or won't they ban it?
Well, I absolutely agree with you about the forced sale, by the way. And let me say not only that you're absolutely right about the way United States policymakers respond to the kind of Chinese threats and demands, but the concerns that have been expressed by the intelligence community that I just mentioned have never been countermanded by the Chinese. They've never said, no, that's ridiculous, we don't do that, here's what we do. And the algorithm is supposedly either some kind of state secret or at least very shrouded in commercial proprietary nature. So, what you have here is a situation where the United States government is given some sort of CFIUS-like ability to look at things broader than just individual apps, but TikTok becomes the first example of this. And yeah, I do think it's eventually banned. I have it now. Before yesterday, I had it at 75% likely by end of 2023. Right now, I have it at 85% thanks to the performance of the CEO yesterday.
Terry, let's talk about timing. How likely is it that it gets banned before 2024, or do we have to wait until election cycle is over before anything materially happens or materially changes with this company?
My view of this today, Lisa, is that TikTok probably gets banned before the end of 2023, and not much more before, because what you end up having to do logistically is you have to have the legislation passed, and people agree on what the legislation is, whether it should be a straight-up ban of TikTok or this broader CFIUS-like process that I mentioned. I think that wins. You have to pass the legislation, get it to the administration. The administration has to set up its process, and then actually have to use the process. We're now at the end of March. I'll give you 9 more months. All that happens, and TikTok gets banned, but not before the end of the year.
There are a lot of
I don't think election politics has anything to do with this when something is as bipartisan as this.
Well, and there are a lot of implications here, whether it's having to do with some of the social issues that a number of Congress members highlighted in these hearings, or whether it's due to our broader international policy. I want to read you this quote from a Biden White House advisor, a former Biden White House advisor. The TikTok battles are indicative of the end of an era. This era where U.S.-Chinese business relations can continue absent considerations of geopolitics is over. Terry, how much does a potential ban of TikTok implicate other companies that are of Chinese origin that do business in the U.S.?
Well, I think it implicates them hugely. Sure. I mean, what you're seeing now is, I don't think I'd agree with the end of an era comment, but that's, what we're now moving into is a situation where the geopolitics are different, frankly. But what you're going to have is Chinese companies looked at top to bottom, and I think American investments in China looked at top to bottom for potentially national security implications in a way that's broader than the way that it used to be done solely under the CFIUS banner, which is and was individual companies, individual circumstances. Those will all be continue to be assessed, but you're going to be looking at this much more broadly in a situation of, what is it that the Chinese government is trying to do? How are they trying to do it? What is our response to either permitting it or stopping it?
Terry, whatever happened to the basic argument for reciprocity? Whatever happened to that argument?
What was the argument for reciprocity, John?
Just the idea that if they want to be here, that the United States should be able to be there.
Well, I think that's still valid. I think that still remains. But what you have is now a decade or more where American policymakers have gradually gotten more aware of other basics, and the other basics include the fact that intellectual property from American companies is stolen in China, that the technology is stolen, that China is using, they would say, piggybacking on American companies to gain advantage, and there is an overwhelming sense that particular area, I think, is over.
Great to catch up, Terry. As always, Terry Haynes there of Pangaea on the latest. Just brilliant. Great note if you can get in touch with Terry and get hold of it. He's leaning hard, Lisa, towards a ban.
85% chance, he thinks, after that hearing. He really does hone in on that one moment where they asked, whether TikTok spies on people who use the platform. And the executive said, I wouldn't call it exactly spying. And that was just, to Terry's world.
I wouldn't describe it that way.
Kaboom.
This was never going to change anyone's minds. And to his point, it's just kind of like the process to then get to legislate. And then ultimately, it's over to the president and the administration to make a decision.
Again, though, I do wonder, he said at this point when there's this much bipartisan support, you can't imagine that politics gets in the way too much. I can imagine it. I mean, I do think that always has been in the back of people's minds because we've been talking about this for a long time. I also wonder how much it complicates the issue that there are concerns about social media on a broader level. And so there's some discussion around that muddies the conversation about national security.
And clearly there's a big divide, I would say a major divide between how Congress feels about the national security issue with China, the reality of the situation, and how the consumers who use that app feel about it. Because I don't think they care about it at all in the same way.
Did you see those comments by Congress members basically saying, I know people are going to think that I'm just trying to take your fun away, but, you'll care about this someday. And you heard a lot of, trying to convince people comments like
this is the argument of the TikTok CEO. And this is the benefit they have, the advantage they have. They've created an app that is incredibly popular with the American consumer. Incredibly popular.
And I would argue that, and I know that this is the case at home because we have these discussions, a lot of people who use the platform think that they are immune to any kind of misinformation. They're immune to manipulation. They're immune to being, sort of influenced one way or another through the platform. They say, we get silly news bits. We get, fun dance moves. We don't necessarily, I'm talking, specifically at home, other people who are progeny. But I'm curious what kind of influences they could be subject to and whether we should have a class on propaganda and the importance of being, just the importance of being.
And communism.
Well, I'm not even saying that. I mean, just the critical thinking skills. I'm talking on a broad sense, critical thinking skills.
Page.
I think that's really important
Blame
to
the education system. I'm with you.
I think that's
They've got to understand
key.
about the dangers of communism.
It's not just communism. It's also
the
propaganda.
whole socialist thought process. I'm with you. It's everything.
Here. No,
it's everything.
No, that's not what I'm saying.
Just go even further. It's great.
No,
Keep
that's
digging.
not what I'm saying.
Troy Gayeski of FS Investments joining us shortly. Ramo's not going to stop.
No, I'm not.
Most actors are thrilled if they have one part like Rocky in their whole career. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone, and it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time you go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
From our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
Inflation is sticky. The Fed has to do something. Its credibility is still on the line.
We don't think that there is a material risk of broad-based challenges. Instead, we've been calling for this bumpy landing.
What matters and what actually shocks my economic and inflation models is how fast they cut and when they start cutting.
The market has anticipated a lot of rate cuts this year, but our economist still thinks it's off in the future.
The Fed is going to be on hold until inflation gets down to something much closer to 2%, and that's, I think, going to take a while.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a move to start Friday with. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Farrow. TK's back on Monday. He's missing out on this. Equity futures down 0.75% on the S&P 500. In the bond market, yields lower at the front end of the curve again on a 2-year. Lisa, by more than 20 basis points. It was today, yesterday, day before that. It's been relentless over the last 3 days.
It's been, since March 8th, it's been over a percentage point. We've seen yields go from 5.1% to 3.6% in just a matter of a couple of weeks as people completely reprice a rate hiking cycle and as they look at something that appears to have broken.
Got to talk about a couple of names, haven't we? Deutsche Bank down 13% over in German trading. Looking at Swiss trading, UBS right now, -7, 8% as well. They're having a soft session to close out this week.
I go to what Elsa Linos says because of RBC. We're talking about how there's a lack of news here. So what exactly is fueling some of the declines that we've seen, particularly in Deutsche Bank shares and credit default swaps? And she said it seems like there are big trades that are unwinding, that people are making big moves that are reflected in different asset classes all at the same time, treasuries and bank stocks. I just don't have a handle on what kind of outcomes there could be in terms of losses, personal pain, and how, I don't want to use the I word. I almost used the I word.
Idiosyncratic.
Yeah.
Yeah, I'm not sure any of this right now is idiosyncratic, is it?
No.
Look at the euro, 107.20. So euro strength has been a feature of this market for the best part of a week, maybe even longer. Euro dollar right now is negative 0.1%. So that's a much weaker euro, stronger dollar in the mix. We've gone from 108.39 at the high of the session, the low 107.19, which is basically where we are right now. That euro weakness developing through the session this morning, even with the Bundesbank president, the chief of the German central bank, coming out and saying we're going to keep on hiking. We haven't won the fight against inflation. Oh, and by the way, you know, QT, I'd like to speed that up in Q3.
Do you think anyone in this market is buying what he's selling? I mean, honestly, if you take a look at German two-year yields, do you actually think that people are saying, oh my goodness, you're really going to be hawkish? They're basically saying, yeah, right. When the facts change, yield change, and we're ahead of it. And that's certainly what you're seeing in the market. I do just want to note one thing before I give you a sense of what we're watching in the day ahead. The data, in terms of where is all that money going, when people ask, going out of banks, it's going into money market funds. And you saw money market fund outstandings surge the most over the past 2 weeks since April of 2020 to a new record, more than $200 billion flowing in some of these funds, which I think is really compelling.
Michael Hahn of Bank of America wrote about this morning. He said up 300 billion, more than 300 billion in the past 4 weeks. He identified the previous two surges, 08-20, and correctly saying that they coincided with big Fed cuts. Now, the inflation backdrop now is very different. I think we all understand that. Will this coincide with big cuts? This market is screaming, absolutely yes. Let's go. Let's look at this market right now. Futures negative 0.8% on the S&P 500. In the bond market, yields lower 14 basis points. Your 10-year sub 330, 328.54 on a 2-year, down 25 basis points. Lisa, it's a breaker 360 at 358.
It's just wild to see some of the moves over the past couple of weeks. And this is the reason why people say economic data no longer matters. You can see economic data surprises coming out, kind of bouncing around positive and negative, basically evening each other out. 8:30 a.m., we get the latest irrelevant U.S. economic data until it is relevant, U.S. durable goods orders. I am curious of whether we see this disinflation continue. What happens if you get a reinflation? What happens if suddenly something comes out that challenges a narrative that credit's getting dried up and that we're going back to a very low inflation kind of environment? At 9:30 a.m., weighing in on this, St. Louis Fed President James Bullard. He's speaking at an event in St. Louis. Over to you. Are you going to basically be like what we heard from the Bundesbank? Or are you going to come out and say, you know what, we're listening to what the market is watching. If we see ongoing stresses in the banking system, that 2-year yield accurately pricing in a rate cutting cycle that could occur? He's not going to say that, but that's what people are going to be listening for. Today also, bids are finally due for Silicon Valley Bank. The FDIC did push back the deadline. There is discussion about who could potentially step in here. It's not a big bank. Right now, the rumor is Customers Bancorp, that's according to Bloomberg reporting, exploring a deal for all or part of the bank. And John, how much is it important that it's another regional bank? Come together moment, band together, get strong, get bigger, but not too big? I mean, this is sort of the question.
Yeah, just right.
Yeah.
What's this, a fairy tale? You know, not too hot, not too cold, just right. It's a mess, isn't it?
Who's the bear and who's the Goldilocks?
Here's another mess. I won't get into that. First Republic right now, down 3%, which is a minor move considering the moves we have seen through this week. Surprised, Lisa, maybe to go into the weekend without some kind of resolution solution for this bank, given all the reports we heard earlier this week that we'd gone from depositing money at that institution to then discussing about doing something extra. And the something extra, it's gone very quiet around that the last couple of days.
Again, we talked about this with UBS and Credit Suisse, where UBS was concerned about the liabilities. Well, what liabilities are you bringing on when you take on one of these banks that does have a concentrated lending portfolio, that does have a greater risk of deposit flight? And that, I think, is one of the hang-ups that's causing delays as people try to assess their due diligence.
With us now, Troy Gajewski, Chief Market Strategist of FS Investments. Troy, great morning for it. Thanks for being with us, and good morning, sir.
They've worked out far faster than we had hoped. Look, I think we're still in a situation where we know inflation's coming down, but we don't think it's going to come down quite as fast as markets are pricing in. And as you know, right now, the Fed is trying to have a very delicate dance, right? On the one hand, they continue to do quantitative tightening, and they've just hiked 25 basis points. On the other hand, they're injecting massive amounts of liquidity through emergency lending facilities. They've undone about 65% of QT in as little as 2 weeks. So, you know, clearly from the banking system side, you're going to get less lending, which creates opportunities for liquidity providers, which is going to constrain inflation. But on the flip side of that is, money supply growth is starting to explode again, and you do have a tremendous amount of cash, and that cash can be used for consumption, particularly in services where we still have an extremely tight labor market. So, up until the banking crisis, it was pretty straightforward. The Fed's draining liquidity, asset prices are going down, inflation's going to simmer for longer. Now you have these opposing forces that are very difficult to price in real time. However, as long as the banking system stresses remain, it's unlikely that you get a significant surge in the 2-year yield, at least over the next several weeks.
Troy, what you just said is pretty radical, and parsing between the lines, a lot of people point to what the Fed is doing in terms of balance sheet expansion, and there's a big debate. Is it quantitative easing, essentially, or is it not? Because it's a unique kind of instrument that is basically an emergency lending tool. What you were just saying there is inflation's not going to come down as much, and oh yeah, by the way, that basically is feeding a lot more capital into the system, and that will boost risk assets. So how long can that go on? Is this basically quantitative easing that will continue to boost risk assets even if it doesn't bring down inflation?
Yeah, so the boosting risk assets is a tricky one, right? Because in the immediate short term, Lisa, think about what this means for forward revenue growth for companies. Think about what it means for forward earnings. So from a multiple compression standpoint, given how much money supply has expanded in 2 weeks, we probably hit the multiple low of 15.5 to 16 in October. However, from a revenue and earnings growth standpoint, it's looking almost laughable that we're going to have 12% earnings growth in 24, and it's more than likely that earnings roll over pretty significantly in Q3, Q4. So we've probably put a floor in the short term for multiple compression. So the next leg down for equities will be driven more by earnings growth rolling over to earnings contraction, and then recession risk, which has been pulled forward pretty significantly and now looks meaningfully darker than it did as recently as 3 weeks ago.
How do you determine catching a falling knife versus finding opportunities, Troy, at a time when people are looking at commercial real estate and saying, wow, a lot more pain there, potentially certain banks, wow, they could also be next. How do you parse out what's too risky and what's just risky enough?
Yeah, it's a great question, Lisa. So I think the catching a falling knife is something you want to avoid. Unless you have to own assets that are going down by mandate, avoid that. Look for areas on the margin that already had attractive opportunities, whether it's interest-only cash flows in residential mortgage-backed securities, whether it's senior secured lending, that will be helped at least marginally by tighter credit conditions in the banking system. So you're not sitting there saying, hey, I'm going to go long the KRE and hope for the best, or start buying up regional banks in droves. Instead, you're looking at strategies that were already in a very good position and can benefit more as credit conditions tighten. The flip side of that is when you look at ways to get at least marginally more offensive. One of the things we continue to look at is dividend futures, which took it on the chin in this sell-off. But if you look at regional banks in general, they make up a very small percentage of dividends in the S&P. And so even if you take those out, as long as we avoid a hard landing, it's unlikely that dividends decline. But clearly, if we have a hard landing, you could take a little bit of mark-to-market pain on that.
Troy, if you'd taken your annual leave, took 2 weeks off, and came back, you'd notice this conversation has shifted really, really quickly from no landing to the possibility of a hard landing and pricing in a massive rate-cutting cycle from the Federal Reserve. Is there any way in your mind that we could see developments in the next 2 weeks that might reverse this conversation again?
It's really hard because, even the upcoming inflation and growth data is somewhat lagged. It's very difficult to capture the degree of potential lack of credit creation and potential credit decline. So the banking system had already started to flatline in terms of loan growth prior to the regional and community bank issues that we're seeing now. So we're pretty certain that lending growth is going to roll over and become negative. But that will not show up in the data in real time. It will start to show up in commercial bank lending growth. So that's probably the best signal to say, again, we're not saying the Fed's cutting as aggressively as markets are pricing in, because we doubt they will.
Yeah.
The reality is somewhere in between where we were 2 weeks ago and where we are today. But it's very hard to see the next week or so where you get a positive catalyst from inflation or economic growth that causes the recent drop in yields to reverse this as rapidly as they've fallen. So very different environment in 2 weeks. It's just a reminder that when the Fed tightens, real things break, and unfortunately, real things are breaking now.
Things are breaking. Troy, thank you. Troy Gajewski of FS Investments. Someone once told me there's catching a fall in life and there's putting your hand in a food blender. I just wonder if that's what we're at right now with some of these names.
I'm just sitting on my hands right now.
Just sitting on your hands thinking of that image. I know it was brutal at the time. I think they were referring at the time to the Swiss franc. This is a long time ago. Patrick Armstrong, CIO at Plurimi Wealth, joining us shortly.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. U.S. prosecutors have charged Terraform Labs co-founder Do Kwon with orchestrating a massive cryptocurrency fraud. It's said to have wiped out at least $40 billion in market value. Kwon was already a fugitive from charges in his native South Korea. He was arrested Thursday in Montenegro. In Japan, inflation slowed for the first time in more than a year. Consumer prices, excluding fresh food, it rose 3.1% in February from a year ago, down more than a full percentage point. But without the impact of government subsidies for energy and travel, inflation would have been as high as 4.4%. China is urging Europe to play a role in supporting peace talks for Russia's war in Ukraine. That's despite the U.S. warning the Beijing proposals would effectively freeze the Kremlin's territorial gains. China's top diplomat spoke to a French official about the peace plan, now not long after the Xi Jinping wrapped up meetings with Vladimir Putin in Moscow. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. News breaks. No one covers the world like Bloomberg.
We've never seen anything like it. This was a decision that maybe was the best out of three very bad decisions, but it could prove to be a mistake.
She opposed Powell's renomination. She called him a dangerous man in 2021. And now she is really pointing the blame at the Fed.
We're expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks.
Bloomberg, your global business authority.
As I've said, we have used important tools to act quickly to prevent contagion, and they are tools we could use again. The strong actions we've taken ensure that Americans' deposits are safe. certainly we would be prepared to take additional actions if warranted.
That last line is a new line from Secretary Yellen, but that new line is not really making a difference. 5 different ways to say the same thing by Secretary Yellen over the last week, and criticized heavily for it, which I don't understand, and Lisa, you and I have talked about it throughout this morning.
The only thing that people are perhaps a little more rightly criticizing is that Jay Powell and Janet Yellen seem to have a slightly different tone in terms of all deposits are basically guaranteed versus we have emergency measures that we can take and we'll come out and we'll make them. Are they different kinds of comments? You can parse out the questions, but there is an issue of anything that can really be done has to come from Congress, and there isn't really the will to do it in Congress.
So what was the purpose of Congress asking these questions of her this week? What were they trying to do? What were they trying to achieve? Signal?
Are you setting me up?
No, I'm just asking.
They're basically trying to say we're on top of it, but we don't want to take legislative action because that could set us up for a political liability. I'm not wrong.
So why didn't you just say that back?
That wouldn't fly well.
As far as I understand it, so far, to the best of my knowledge, it is up to you to legislate to change the cap on deposits.
Because then she's setting a signal that the banking system needs that, right? So this is she's caught between two very difficult decisions. How does she come out? She tried this the first day, it didn't work, and saying totally resilient. We don't need to do anything more. We can step in potentially if there's a problem, but we're not discussing major measures because everything's fine. Didn't work. Stocks tanked. And then the next day she comes out and they say, okay, well, how about now? E2, Brutus. And she's like, well, things are.
Let's go back 2 weekends.
Okay.
Go back 2 weekends. There were banks that some people outside of this country had never heard of before that failed, and they used the systemic risk exception to make those depositors whole. How small do you think the bank would have to be? How irrelevant do you think the financial institution would need to be at this point, in this very febrile moment, for it not to be given the systemic risk exception?
That's a fair point.
My question is, ultimately, there is so much she's implying here. There's so much information implied through what she's saying that is ultimately, we're going to be there again to do the same thing and make depositors whole. Because at this point, you'd have to imagine that any financial institution that they just let fail and didn't make depositors whole would have some degree of contagion risk associated with it.
The problem is there's going to be a cost associated with that, so that continues to make stock investors nervous, and you're not solving the ultimate problem, which is a mismatch in the duration of the assets and the liabilities of some of these smaller banks that have more volatile deposits and more concentrated deposit bases. So if you're not solving the problem, then she cannot talk her way out of this, and it's not her problem to talk her way out of. It is ultimately something that lies with Congress.
We're on the same page. I said earlier, give it a few more days and the hold-to-maturity portfolio will no longer be underwater because this bond market rally is rip-roaring and fast. The 2-year yield's down 19 basis points, 364. The 10-year down 11. We're at 331. Equity softer this morning, down 8 or 9/10% on the S&P 500. And the euro, even with some hawkish central bank talk from the German central bank governor, the euro is still weaker. Euro-dollar negative 0.9%. The euro against the dollar 107.39. Joining us now from DC, Anne-Marie. AMH, what more can Secretary Yellen say?
Well, I think what the strategy is going to be is that she doesn't say any more. Yesterday was a cleanup, clearly for the markets, but also for Congress. It really throws this idea of the FDIC insurance limit and that cap in their hands. And I think that's what Secretary Yellen was trying to say on Wednesday in her Q&A when she was asked about this. And she said, we have not discussed this blanket approach to FDIC insurance, cat depositor insurance, because that is in the hands of legislators. That is lawmakers. But the markets obviously tanked. So yesterday she wanted to make sure that she put the markets well aware that if there was a systemic emergency need for this, this is something that they could step in. And I think for now, that's all we're going to hear from the Treasury Secretary at the moment. But of course, if there is going to be more contagion and they have to step in, there will likely be more statements from either Yellen or Fed Chair Jay Powell.
Perhaps we're talking too much about Janet Yellen, and really the interest lies in what was not discussed yesterday in that hearing, or the lack of questions really around deposit insurance. Mostly people were curious about the budget and the debt default ceiling and things of this nature. What kind of signal do you take from that in terms of the willingness of Congress members to take any action on deposits, especially given that there are political liabilities around that?
So when it comes to the deposits, When I speak to congressmen and women, all they keep saying, and senators, is that they want to see all the details first. And they don't just want to shoot at the hip because there was a crisis and react. So next week, there's going to be a ton of hearings. And you're going to have regulators on the Hill. They've also invited bank executives on the Hill of these failed banks. And I think after that, you potentially will maybe see momentum in if Congress is going to raise the cap. Like Senator Elizabeth Warren said, like Congressman Boyle said to us last night, they don't know a number yet, but potentially north of $250,000 could be lifted. When it comes to the debt ceiling, this is actually starting to heat up a little bit because we heard from the Republican budget chair, and they said that they are ready to go to the White House with what is called a debt sheet, not a cheat sheet, a debt limit sheet. I'm basically telling the Biden administration from Speaker McCarthy's office and the House Republicans, these are the demands we have in order to sign up to raise the debt ceiling. But one thing is key there. The White House has said they want to see the Republican budget. That's not going to make it by April 15th. So they're trying to go with this minimum sheet to the White House and say, these are our demands. Can we start negotiations? But it's finally the first time since McCarthy and Biden spoke on February 1st that we are seeing an inch towards potential discussions on debt ceiling talks.
How did talks go with Trudeau? What was that about?
Well, he's still there. The president is in Canada. He's in Ottawa. Josh Wingrove is traveling with him. They are discussing potentially asylum seekers and a deal on that. They're also going to be discussing things like the war in Ukraine, Canada's efforts to support the U.S. and other allies. This is really just a normal stop for the president. You always have to visit your neighbor to the north. I wouldn't expect a lot of news, but it comes at a great time for Biden. If you noticed, he hasn't been out front talking about what's going on in the markets. He's left that to his Treasury Secretary. Obviously, Fed Chair Jay Powell talks about it. This week, Biden has really... Yeah, he's been talking with celebrities. Bruce Springsteen was there this week. Ted Lasso was there this week. He's in Canada. And when he comes back, him and his administration are going on a 20-state tour to pitch the legislative success they've had the prior 2 years. All of this, obviously, as he gears up to announce for 2024.
So you're saying the president at the moment is in campaign mode?
I would say at the moment it's partially campaign mode and also pointing the finger at Congress, pointing the finger at bank executives, and letting his cabinet members, and like Treasury Secretary Janet Yellen, and also the likes of Lael Brainerd, the head of the NEC now, Jeff Zients, his chief of staff, letting them deal with the market fallout and not getting the president in front of reporters or cameras to talk about it. This could be also because they don't want to spark more fear and risk. If the president really is concerned and starts talking about it, then that's quite probably a little bit of nervous jitters for the market as well.
AMH, thank you. Anne-Marie, down in Washington, D.C. There's two ways of looking at this, Lisa. One is that, another way is that he's just leaving as Treasury Secretary hanging out to dry. That's one way. Another, to Anne-Marie's point, they're damned if they do and damned if they don't right now. If you see the president on your screens every day talking about a banking crisis in America, it's probably not what you want to hear from the president every single day when you're trying to let this settle down, is it?
No, and I think that's the reason why they haven't really come out with the same kind of, we're proposing emergency measures, this is a serious issue. They're trying to do that, but behind the scenes, and that's the reason why people are looking at the data, looking at how much money still is being lent out to banks and saying, it isn't all clear yet.
Ted Lasso. Is that why Tom's off? Just, honestly, just finally just understood why he's off.
Because he's down there fanboying over Ted Lasso.
Binging Ted Lasso. Is that season out? I haven't watched any of it yet.
He's doing it alongside President Biden, who evidently...
Did they drop the whole season all at once?
I don't know.
I don't know either.
I don't think
I'm trying to watch it this weekend.
BritBox.
BritBox? What's BritBox?
It's like British television in the U.S. BritBox.
Right, nice.
best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Is this show available on BritBox?
I'm not sure. It depends on... I think that Tom would actually make it more like BritBox than you.
Tom probably would, yeah.
100%.
He's such an Anglophobe. He just loves the UK.
Basically, every conversation is, this is how they do it in America.
Anglophile, rather, I should say.
But John, isn't it so much better?
Sometimes with me, he's an Anglophobe, just doesn't like being around me, but anyway.
But no, seriously, like, John, isn't it so much better over in the United Kingdom?
He asks me that question all the time. The reason he asks me that question is to try and get me to offend Americans. Which is why he always asks the question, because he hopes that one day I'll just go home. It's not happening.
Good.
From New York right now. Good morning. Equity futures negative 0.75% on the S&P 500. We're a bit softer, lighter, lower, negative. Big moves in the bond market, so let's discuss them. 2 year earlier, sub 360. Right now, let's call it 365. Still lower, though, aggressively so by 18 basis points. On a 10-year, we're down about 11 or 12 basis points. 330, 331 on a 10-year. This whole curve just gravitating towards 3% at the moment. I don't know what's going to disrupt that trend. This is basically the trade that Bob Michael at JP Morgan Asset Management was pushing. He said the whole curve, 2s out to 30s, can drop to 3.00%. Who am I to argue with him? We're only about 30 basis points away on a 10-year. Outside of that, in the FX market, the German central bank governor saying, let's go, there's more to do. And in Q3, I'd like to speed up QT. And then the euro starts dropping. Euro dollar, 107.45, negative 0.8%. It's a real turn in risk, I would say, in like the last, let's call it 2 hours, Lisa, where equities kind of fell out of bed, the dollar ripped, and the front end of this curve really started to rally quite hard.
I don't like giving a narrative to this because it's impossible and I'll be made to look foolish pretty quickly. I do wonder how much is technical in terms of unwinds that are going on, because it's hard to explain the underpinnings of it. And we take a look at some of the names that really have driven some of this, and it really is in the bank complex, particularly over in Europe. Deutsche Bank, I'm looking at the ADRs right now, the American Depository Receipts, and they're down more than 10%. Why? I don't know. Pick your narrative, pick your reason, but we're not necessarily seeing it. Similar with UBS, those shares down not as much as Deutsche Bank, and perhaps there's more of a rationale, but you saw the turn lower, John, to your point, only recently, accelerating with losses. Both of these shares near session lows, those shares down more than 5%. And this is bleeding back into the regionals in the U.S. I'm looking at PacWest and I'm looking at Western Alliance, not First Republic, but some of the other shares of banks that have come under pressure in the United States. PacWest shares since March 8th are down 65%, and Western Alliance shares down 56%.
Mental.
Massive, and it just continues at a time where there isn't a sense of what's going to cap the fear that some people have been perpetuating.
Everything we've talked about all morning, and the biggest amount of feedback I've had, obviously, is over Ted Lasso. Everyone wants me to know it's episode by episode. Season 3 is out. It's available on Apple TV. I mean, what is this, a commercial? I kind of knew that already. I just didn't know whether it was all at once. I just couldn't remember. I couldn't remember because I never watched season 1 when it was coming out. I watched it after it was already out, so I binged that. I wasn't that impressed with season 2. I've got to be honest with you.
All right. Well, you'll get a lot of
see
mail
what's in
about
store
that
for
too.
season 3. I'm sure everyone's got an opinion. Everyone's got an opinion.
I think I should get BritBox. I think
You
I
should
could.
get
Yeah, I think
BritBox.
so. I think I.
What are you going to watch? Coronation Street.
I think I'm going to watch some soap operas.
You
and,
should.
You know, basically, you know, it'll bleed out into the show.
That's how you switch off and relax.
Used to watch British soap operas.
Totally. Other people's problems, you know, not your own.
Thank you. I like
Deborah
that.
Cunningham, Global Liquidity Markets CIO at Federated Hermes, joins us now. Deborah, this move in the bond market is just a monster move. This 2-year, to see the yield down another 18 basis points. I know we've got used to moves like this, Deborah, but it's not usual. It's unusual to see the bond market move the way it has done over the last couple of weeks. Deborah, what do you think it signals?
You know, I think it signals that there's unrest and unsurety in the economy. So, you know, we over the course of the last 2 weeks, if you look at, you know, sort of Fed funds futures, we've gone from, you know, prior to the regional banking issues here in the U.S., expecting a terminal rate of 570, you know, all the way down to expecting a terminal rate of 460, and, you know, now kind of back up in the 510 area based on the FOMC meeting this week. But I think there's no conviction. People see, you know, different statistics being reported from an economic standpoint, whether they're inflation, retail sales, any number of statistics. And then they see stories about Credit Suisse, stories about Silicon Valley Bank, the Bank Term Funding Program. And there's just, I think it's sentiment based on what the last information was that you saw, and it's driving the market on a day-by-day, hour-by-hour basis up and down.
Deborah, yesterday afternoon, the Investment Company Institute came out with data on total inflows into money market funds in the U.S. over the past week. And just looking at this, it's been the biggest 2-week increase in money market.
2008 financial crisis time period. I think those were driven by mostly fear, and basically people were leaving the risk markets, the equity market, the longer term fixed income market, and they were being driven into deposits and money market funds. For this one, I think there's money coming out of deposits. Maybe it started from a fear perspective way back 2 weeks ago. Seems like it could have been, you know, 2 months ago at least, but it's only 2 weeks, with the issues surrounding Silicon Valley Bank and Signature. And ultimately, I think what that did is cause people to look at where their short-term liquidity is, and a lot of it is in uninsured deposits or in insured deposits, but with very, very low rates, 75 basis points, 1%. And then when you look at a money market fund, you look at something that's giving you 4.5, you know, climbing towards 5%, with a lot of diversification and much higher credit quality than what a bank loan portfolio would give you, which is what typically would be backing bank deposits. So I think it's a little bit different as to the origin of this cash for this time versus what it was in 2020 and 2008.
So is it not reflected necessarily in what your clients are doing, what they want to see in terms of positioning of their assets? Have you not seen the same degree of inflows that you would expect at a time of a mass rush into money market funds?
Well, we have. We've seen a huge amount coming in to our liquidity products and to our money market fund products, and very much reflective of the information that the ICI has provided, very much reflective of Crane data. You know, money market assets are at all-time highs, but we're not seeing it go out of our equity and longer-term fixed income products. Instead, what we're seeing is, you know, deposits at banks down, you know, over the course of the last 2 years, $2 trillion, and on a week-over-week basis, the most recent data showing that continue to decline. So I think it's coming out of other liquidity products that are just much lower in yield, and given what happened with Silicon Valley and Signature Bank, I think reflective of diversification in the liquidity markets into money market funds from those deposits.
Is this a problem that can be solved with rate cuts?
Well, I think it's, you know, it's something that ultimately could get you back to zero if there were truly a crisis, but I don't believe we have a banking crisis. And so simply cutting rates, by 50 or 100 basis points, as the Fed projections say they might do in 2024 and 2025, isn't going to change it much, because bank deposit rates lag interest rates going up, but are sticky with interest rates going down. So I don't think you're going to see, first of all, I don't think you're going to see a return to zero, or not in that type of a situation. Bank balance sheets are very healthy. There's lots of equity, lots of healthiness in the bank market. And I think that, minor cuts that might come in 2024 or 2025 are not something that's going to see parity again in that sector for a little while.
Deborah, what do you suppose is more important to this Fed? What a rate cut would achieve, or what a rate cut would signal?
I think what a rate cut would signal. I think they see very little from an achievement perspective, and I think they got a little bit of cover, if you will, from what the ECB did last week with a 50 basis point rate increase, and no huge ramifications that came from that. And they even had, they were dealing with a larger issue with Credit Suisse. So I feel like that gave the Fed a little bit of cover to increase rates this week, 25 basis points, and I think that's exactly the signal that they wanted to provide. They are still fighting inflation. They are still on their, dealing with their core mandate. They are not fighting some sort of financial crisis here in the U.S.
Deborah Cunningham of Federated Hermes. Deborah, thank you. To some point, to some extent, Lisa, let's explore this. The Fed could get themselves in a bit of a bind here. They've basically told us that the financial stress, the difficulties, instability, pick your word, whatever, of the last 2 weeks is a substitute for hikes to some extent. They might have put a number on that of about 50 basis points. So let's say it's 50 basis points over the last few weeks. Let's say it gets worse. We're in and around where the median dot is right now, of 5.1% for 2023. If it gets worse, wouldn't it make sense to reduce interest rates? Because you're saying that a financial instability is a substitute for rate hikes. And if you think you're very close to what you think is going to be sufficiently restrictive, isn't some form of adjustment required?
This is the logic that's underpinning perhaps the move that we're seeing in markets. The question is, if you still see data that comes in hot, if you still see that consumers are spending, although it is softening, some of the credit card surveys show, then how do you diverge from what you said 2 weeks ago, 3 weeks ago, 4 weeks ago, which was inflation is the #1 concern, not we want to make sure the banks are okay. So before you get the data showing how much lending is being constricted at some of these banks that are losing all those deposits that we were just hearing about, how do you justify that with a consistent message?
It's the fear of what you'll signal. And I think that's the issue with Fed policy at the moment. It's the obsession with what you're going to signal if you did start to adjust interest rates. The other difficulty I have, and I was discussing this with David Bianco of DWS yesterday, is that you can reduce rates but still have monetary policy that is tight, particularly if you have financial instability concerns continuing and lending standards tighten. So this idea that the Fed's backing away from rate hikes and that's being a good thing. Look, you have to think about it this way. It's important. If we had the SCP 2 weeks ago, that median dot was coming up to 550. The fact they've left it at 5.1, on top of the financial instability we've had over the last 2 weeks, I don't think that's dovish. I don't think that's dovish at all. They're saying, they're putting a number on it. We were going to be at 550. We probably think this is worth 50. We'll stay at 5.1.
It's not particularly encouraging to think that banks suddenly are not having deposits and cannot make loans, given how much that was a driver of growth.
The market's essentially saying, this isn't enough, you're going to have to cut loads, and it could get worse. It's just interesting, the equity market's been resilient over the last couple of weeks in the face of that conversation. Really resilient.
People want to see some strength there, and honestly, the Federated comment, they're sticking with it.
Rallying through the storm in the equity market over the last couple of weeks. Henrietta Tracy is going to join us from Veda Partners on TikTok and a whole lot more.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. UBS and Credit Suisse are among the banks being looked at in a U.S. Justice Department investigation. Authorities want to know whether finance professionals helped Russian oligarchs evade sanctions. Now, subpoenas also went to employees of some major U.S. banks. Credit Suisse and UBS both declined to comment. The CEO of Standard Chartered says the worst moments of the banking crisis are over. Bill Winters spoke to Bloomberg's David Ingles in Hong Kong.
I hope we're through the worst. And I think there's still some questions around business models around the world. Have there been weaknesses that have been exposed in the business models of any of the companies that have had trouble that need to be addressed at this point? But it certainly seems that the acute phase of the crisis is done.
When asked if he would be willing to buy any of Credit Suisse's assets, Winter said Standard Chartered is always interested in looking at things with a decent return. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
Has ByteDance spied on American citizens?
I don't think that spying is the right way to describe it.
Right.
This is ultimately...
We can differ on that.
This is ultimately an internal investigation.
Face palm. Really hard. Just brutal. Brutal. I don't think spying is the right way to describe it. I thought his performance yesterday was super polished. Said a few times already this morning. Very slick guy. That was a tough moment, a really tough moment.
They were looking for one slip up and they got one. And it's not necessarily substantive necessarily, we don't know. But the bottom line is there's an impression that the Chinese government could get access to the data that is collected by TikTok at any time that they wish. And he was not able to allay those fears in the way that these politicians would have liked. Not that they could have had those fears allayed anyway, regardless of what he said.
That exchange, has ByteDance spied on American citizens? I don't think that spying is the right way to describe it. I could play that all day. That's just insane.
Pro tip, anyone asks you that, the answer is no. And then you can say whatever you want, but you answer very directly so that the soundbite captures.
But he wasn't able to say no.
Correct.
He said that instead.
Right.
What kind of questions and concerns does that raise?
Correct. I mean, that's the issue. He should have just said no.
How would he describe it?
Collecting data that could be used for lots of other purposes. Okay, but what's the distinction between TikTok and other social media companies?
Oh, it's a massive one.
And this is
huge
one distinction, and it's just one.
Monster distinction.
Which is?
Facebook's not there.
Well, is that the issue, or is it that the Chinese government
massive distinction
has also shown recently that they are more willing to encroach on business-government divide, and they always have been?
Why isn't Facebook there? because the concerns that the Chinese government has about foreign tech is exactly the same concerns the US has about tech coming out of China right now. You know, this goes back to, I used this word earlier, reciprocity. I'm not sure what happened to that conversation. Why aren't we talking about that a whole lot more?
At what point, though, does that stretch into Apple? Does that stretch into all of the big tech companies that have substantial businesses in China, regardless of what IP or what other types of security issues could get breached?
True. Henrietta Trace joins us now, the Managing Partner and Director of Economic Research at Vader Partners. What a moment, Henrietta. I wouldn't describe it that way. I don't think spying is the right way to describe it. What were your thoughts when you heard that?
Please stop. I mean, that was so terrible to watch. That was really tough. And it was definitely one of the most aggressive hearings that I can remember watching. And I've seen quite a few of them. But I agree with your point. I think he did as great of a job as you could have done. The members knew what they wanted to get out of that moment, out of that 5-hour hearing. And it was, as some of the members were saying, the most bipartisan committee and the most bipartisan hearing that we've seen in a very long time. And I think that is really what drove the attention yesterday. And they got the soundbite they wanted, as you pointed out, Lisa.
Well, but Henrietta, how quickly can they actually get something done? And where is the actual political will to do something that could make some serious ripple effects, particularly among younger Americans?
I'm really glad you asked. I don't think that there will be material legislation targeting TikTok specifically, and I do not think that there will be a national ban. I understand that yesterday's hearing was very explosive, got a lot of attention. It was the banner headline across all media platforms yesterday, but the Congress is not in a position to pass legislation to ban TikTok right now, even constitutionally if they could. What I think is happening, and I would encourage investors to do, is watch Catherine Tai, the U.S. Trade Representative, today when she's up on the Hill for the second hearing in front of the House Ways and Means Committee. That's where you're writing a big, comprehensive China bill, and we saw her give a preview of that yesterday at Senate Finance. They were dueling hearings at the exact same time, but if you didn't want as much fireworks and you were more interested in policy, you would have watched the Senate Finance Committee hearing, and that's what I was doing. So I would encourage people to watch Catherine Tai today, Ambassador Tai, at 9 a.m., because they have issues about China's expansion into Latin America, Brazil, Russia, IP theft, human rights, climate issues. This is the TikTok issue is one that effectively brings everybody to the yard, gets that bipartisan support we're looking for, and allows them to craft a comprehensive China bill, which the Biden administration is hoping to do after the debt ceiling standoff is resolved, or worst case scenario, in his next term if he gets reelected.
When it comes to the consequences of this, how much are you watching TikTok and how much are you watching Apple and other big tech companies that have substantial businesses over in China?
This is exactly what's in the Restrict Act. That is the one bill that I do think could pass on TikTok. It's really about all emerging technologies, all social media, and it doesn't just target China. It also targets Iran, Russia, Venezuela, Cuba. It's the most comprehensive, and it could theoretically put every social media company on the front of the table and allow the Department of Commerce, obviously run by an extraordinarily competent Secretary Raimondo, to see what they want to do, study the issue, and then restrict and ban if they see fit.
The TikTok CEO had a tough day. Secretary Yellen has had a tough 2 weeks. Henrietta, let's talk about policy. Where is this policy effort going on the banking front?
Nowhere fast. I have spoken with Democrats and Republicans, House, Senate, for the last 2 weeks or 2 years, however it's been since SVB collapsed. The reality on Capitol Hill is that the House Republican Conference is not prepared to move legislation on banking at this time. There are many ideas floating around, but there is no path to 218 votes from a majority of the Republican conference in the House on any legislation. And what I hear time and time again is that you need to see the impact of this banking crisis and the collapse of a couple sort of bespoke boutique firms, which is how a lot of House Republicans think about this, really start to hit the heartland. You need to see farming banks, farming state impacts. You know, it can't just be commercial real estate that is reeling from Republican conference. I would say about 80% was not in office during the Great Recession, and they were not here during the banking collapse. And many of them ran on the campaign of "We are against bailouts. We're against TARP." And when they look at, you know, ensuring all deposits and passing legislation to hike the $250,000 cap
all they see is bailout, and that's not going to pass in this Congress.
Do you see and can you identify a mechanism for the Treasury to move forward and temporarily suspend the limit on deposits? Is there a mechanism that exists in your mind?
Yes, absolutely. And one thing that I recall, I was in the Senate during the banking crisis, the ability of regulators to act is unparalleled. And the things that they can pull out of a hat are really impressive. So I think the most focus right now, what I've spoken with Senate Banking Committee staff on, and I know Treasury is working on, is shoring up all the things that we would think of for extraordinary measures on the debt ceiling. I would encourage folks to look at Secretary Geithner's letter sent back in 2012, where he lays out like 5 different baskets of funding that the Treasury has exclusive authority over that they can tap into in the event of a crisis. This circumstance I'm referencing was the debt ceiling, but they can use that here as well. The ESG fund in particular is getting a lot of attention. Treasury Secretary Yellen, once President Biden gives her the sign-off, is authorized to use the funds there, which were $216 billion as of January 31st of this year, to deploy as she sees fit. So I think that's where a lot of the focus should be. It's on the regulators. Importantly, I think the regulators know that Congress is incapable of action, and so they are already prepared to move, and they have experience if the members of the House do not.
Just to finish on Secretary Yellen, she was asked whether she'd discussed some of these issues, and she said she hadn't discussed them. And I struggled to believe that, Henrietta, just struggled to believe that the Treasury hadn't had a discussion about doing away with the cap on deposit insurance through the mechanisms through which you've identified. Were you surprised that she used that language?
I do think that there's been some maybe back and forth in terms of what they're telegraphing, but I also get the sense the Treasury's trying to exude calm and stress, as the Federal Reserve helped them do earlier this week, that there's not a systemic banking crisis. So I do think that acting unilaterally to, provide unlimited backstop would have gotten a lot of blowback if she'd committed to that. Just think about how quickly that sounds like a bailout, especially when you've got guys like Gary Cohn throwing out $10 million numbers. It's just too high. So I do think that there was some strategy involved there, which was the worst scenario. Say that you are considering it on an unlimited basis, or maybe just say, hey, we haven't had that conversation. I think she picked the least bad option.
What a tough spot. Henrietta Trace there of Vader Partners. Who would you prefer to be this week, Bramo? TikTok CEO, Secretary Yellen? Take your pick.
Oof, TikTok CEO, because you had nothing to lose. You already were going to be maligned.
Just lose.
Exactly.
Just lose. You'd lost already.
Exactly.
Patrick Armstrong, Larumi Wealth coming up.
Welcome back to another Miami Open update for Bloomberg TV and radio from Tennis Channel. I'm Johnny Ray Diaz. Carlos Alcaraz will be the headliner Friday in the Sunshine State. The Spaniard took the title at Indian Wells last week with an impressive straight sets win over Daniil Medvedev, which also took him back to world number 1. He faces Argentina's Facundo Bagni in his opener at the Hard Rock Stadium. And don't forget, you can watch all the action exclusively live on Tennis Channel.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's Renewable Assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children.